take you through the rest of this hour as we wrap up the trading day. Futures market closes at 5 Eastern. If you're on the website, on the platform, thanks for joining us. If you're not there, go to tastylive.com and see what we're all about. Or come over to the YouTube page, join the conversation. What did you think of today's action? I certainly found it a little confounding after all the theories we laid out here on Overtime yesterday, Ilya. Gold down, dollar up, stocks up, bonds up. Looked like things were getting better. And yet it's a tale of two cities today because the dollar's down and gold is back up. And if you just looked at the world through that lens, you might surmise that stocks and bonds were down, but that's not the case. Stocks and bonds go up and they stay up for today's session. S&P 500 here after hours, 55.25 and a quarter as we turn to the charts. It's a 2.3% gain. We did have Google and Intel earnings here after hours, and so I think that's worth going into first. Mike, you're our resident vol expert here today, although I don't know if Dylan satisfies that requirement when he's here usually. Tell us what you think about these Google earnings, because it's a nice little move here to the upside here. Now 169 and a quarter after closing 161.47.
Yeah, it's nice to see that these stocks aren't just tanking after earnings. I think a lot of these stocks are, of course, going to use the buzzword of tariff and tariff implications, et cetera, et cetera. I feel like every few years we have the buzzword of the session, whether it's blockchain or AI. This time around, it's going to be tariffs. So you're going to see some companies kind of go at it head on and talk about it. You're going to see other companies shy away. Like I think Southwest Airlines pulled back their forecast for the next 2 years because of market implications or market uncertainty, I should say. But yeah, Google up after the close. We'll see what they say on the conference call, but it's nice to see that it just didn't plummet immediately. We'll say that. And I think really when it comes down to volatility, so I was talking to Nick earlier today, I think the calming volatility environment, I think is, of course, more of a bullish sign than bearish sign, but I think it will allow traders to invest in these stocks or buy into these dips when we're not seeing a steep contango. Like we barely have a contango anymore in the volatility futures right now. And I think if we had a 5 or 6 point backwardation like we had a couple weeks ago, you still might see some people shying away from diving into these stocks.
Ilya, you seem to be taking a little bit more of a bearish tack to this approach. Before we get into what's happening in the broader index, though, Google earnings 281 versus 201 estimated. Strong basically across the board and everything. Some of the revenue figures actually did miss. YouTube missed 8.93 billion versus 897 expected. Cloud revenues 12.26 billion versus 12.27 expected. Traffic acquisition costs higher, 13.75 billion versus 13.366 billion. Nonetheless, it's a story that the market likes. Google here now up 168 after hours. Ilya, you were on last call sounding a little defensive there, my friend.
I mean, it's not an easy day to be a bear, to be sure, but I'm sticking to my guns because I don't think anything has actually changed. If you look at the daily performance, yeah, it's a big up day. We've had a lot of volatility. Lots of these days have been big days relative to how much these markets used to swing. But look at where we are. And by the way, what you're seeing here on NASDAQ is exactly the same thing that you see on the Russell. It's exactly the same thing that you see on the S&P. You're backfilling to the underside of the range. The last time you tested here, this is the range from March that we cracked at the beginning of April. Obviously, we had that big one-off run where we tested that underside and failed. Well, we're testing it again. My mind, the risk reward here makes absolutely no sense to go long. And in my mind, the trend is down. So if I'm doing anything here, it's selling. And if it's wrong, it's wrong. I mean, if you break out here, then the trend has changed. The series of lower highs and lower lows has run its course for now. but it hasn't as yet, and this is the deciding line. So for me, the tactical thing to be here is short. Now, I'm doing it in a risk-defined way with verticals that have locked in losses of no more than 1 to 2% of equity, depending on index. And obviously, it's been more expensive on the Nasdaq side, less expensive on ES, and even less expensive on Russell. So I'm fine with basically taking a kind of trader's approach here and saying, well, if you had to look at this from a pure risk-reward perspective, what's the upshot? If you're wrong quickly, and if you're right by more. So I'm on the short side here.
Mike, you are a buy the dippers kind of man.
I was gonna say, who let Scrooge McDuck in here? But no, I mean, I hear you and I see it. And I'm actually doing similar stuff. Like I would still rather be long than short a lot of these stocks that have already gone down. But the last couple of days, I did put on some larger hedges. So 2 days ago, I put on a diagonal spread in SPY, long the June 540, short the May 525, and then I have a Q's position on to the downside as well. So I agree. Even if you're long, I think it's smart to put on some hedges here because we are at the level where we sold off aggressively multiple times. And if your hedges don't work, then the rest of your portfolio is if you're bullish. So I agree. I agree to a degree. We'll say that. But yeah, I think one of the big differences, of course, and really like we see volatility flying around all over the place, but I think it's encouraging to see volatility futures in the low 20s and much more flat than we saw over the past couple of weeks. Even when we reached this level at 550, when we had that huge explosion to the upside, and a couple of days later, we were still much more backwardated than we are now. So whatever that means for now, that can change on a dime. If we have a 120-point sell-off tomorrow, volatility futures will go back into a steeper backwardation. But I think, if anything, I'm looking at that to see if we maybe have a calming period here.
So technically, some interesting things are beginning to happen. Ilya, I will concede to you on the bear side that we haven't necessarily cleared any significant technical threshold just yet. We haven't punched through the area where we found swing lows in March and ahead of Liberation Day. We haven't broken the downtrend off the February and March swing highs, or even the April high here. But today is a bullish outside engulfing bar in the indexes, both in ES and in Q. We cleared yesterday's lows. We move above yesterday's highs on a closing basis. We likewise see that the 1 month moving average is beginning to develop a positive slope again after today's close. That's how good it was. And I would add perhaps a third layer to all of this, which is that with today's move officially, we now have what's known as a Zweig breadth thrust signal that is active in the markets. This has happened 17 times previously. 17 times previously, you get a Zweig breadth thrust. What is that? That's when the 10 EMA of NASDAQ advancers over the ratio of total advancers and decliners increases from below 0.4 to above 0.615 within a 10-day window. Again, 17 times in history. A week later, the market's higher by 1.2% on average, 88% of the time. A month later, it's higher by 5.08%, 94% of the occurrences. 6 months later, it's higher by 16.35% on average, 100% of the time. And a year later, it is higher by 23.78% on average, 100% of the time. So something has transpired here technically in the market in terms of the composition of how individual stocks are behaving beneath the surface that suggests there has been a very meaningful shift in price action and positioning over the past 3 days that makes me think that maybe we have a workable low, despite what the headlines are saying right now. the headlines are obviously the wild card here, Ilya, that makes, you don't have the commander in tweet in any of these other events. That kind of makes them perhaps not necessarily reliable, but gosh darn, something with a 100% hit rate 6 months and 12 months out. I like that if I'm a bull.
Well, I'll tell you this. First of all, the Economist cover indicator worked like a charm.
What is it now?
Last week, well, I haven't seen the one for this week, but last week it was a very dollar bearish cover, and the dollar has stopped falling. So that's one indicator that this kind of sell U.S. narrative is over.
We have a good one this week. This is
what do you got? What do you got?
Okay. You and I have done this for a while, Mike. So I gave a present. Ilya helped me out with this years ago when I first started working. I gave a presentation in Las Vegas at one of these expos where I pointed out that in financial media, when you get certain financial outlets that cover certain events in certain ways, it almost guarantees to be a turn in the market because it's an extreme in sentiment.
Markets in turmoil.
Markets in turmoil,
yes.
Exactly, right? Yeah. But the Economist actually fits the glove when it comes to macro issues.
Yes.
Okay. Famously, they would have something of
this
like
is the markets in turmoil of macro.
And I've tweeted about this over the years, but like you'll see like George Washington with a black eye, and then you put that Economist cover on a euro-dollar chart, and it's like 2 weeks before the euro peaks and declines by 25% over the next year.
That's the dollar bottom right there.
And then like the next time the Economist runs a dollar cover, it's like George Washington flexing. And again, it's like a month before the dollar bottoms, and then the euro rallies 15% against it over the next like year, right? So Ilya, knowing what the Economist would do in this situation, what would that cover look like to be a really bad cover and give us a negative, a contrapositive signal in effect?
I don't know, some sort of U.S. dollar on fire.
Right, let's go with an American Eagle that looks like it just got the shit kicked out of it.
Oh, perfect. Perfect. I need to rethink my short exposure immediately. Immediately.
So consider this point number 4. Forget this wide breadth thrust, which is like
perfect.
100% hit rate.
This is what I needed to see. If you take a look at last week's cover, and I tweeted it out, it was a kind of reworking of the famous painting, The Scream, and the subheading was, here's how a dollar currency crisis would play out, and I'm like, oh, I need to get out of my U.S. dollar shorts within a few days here. And indeed, once the price action, there it is, once the dollar stopped falling this week, I definitely got out. I still have a little bit of a long Aussie dollar short USD exposure, so I'm not fully absent from participating in this risk on move, because obviously the Aussie is rallying on this. So I'm nibbling a little bit on all of this optimism, and of course the bonds are rallying, and that's probably my biggest exposure portfolio wise at this point.
But you don't have your identity wrapped around being an equity market. Anything else besides an equity market?
I don't care.
So
I don't care. Bull,
it's a little
bear,
more personal. It's a little more personal.
Well, bull, bear, whatever. I just want money. That's really it. I'm just trying to make a trade that has positive P&L. I could care less if it's bullish or bearish as long as it's right.
They should the next time Clay Holmes is on the mound, cover the spread for his strikeouts, right, Mike?
That's right.
That's how you make some
Our
money.
savior.
Anyway.
but yeah, I look at that Economist cover and I go, it breaks these technical levels on ES and NQ. I need to not only close out these shorts, but flip them over.
This is another good day for the sector rotation, Ilya. You know that whenever we go through this, I like to just look at what's happening beneath the surface in terms of distribution to get a sense of, is this a good rally, right? When the market's bouncing back and healthcare and utilities are the leaders to the upside, you kind of look at it with a little bit of cynicism, saying, are people really excited about which way things are heading? That's not a claim you can make today, though. SMH is your top sector performer, 5.05% to the upside. We take a look at our next best performer, technology, XLK, higher by 3.73%. For good measure, something like telecom, up 2.74%, back above its 1 month moving average. even an XRT, retail, starting to rebound a little bit here. And then the stuff that broadly underperformed, staples is the only sector in the negative. But do we really care if staples, which is something that you don't want to be a leader, do we care that it's pulling back a bit? Maybe burdened by Pepsi's really weak earnings. By the way, Pepsi's earnings show what at least one company's planning on doing for inflation and tariffs. They're passing on the prices fully to the consumers. If you look through their report today, utilities here, another defensive sector, it's up today marginally, but it's not a leader is the point. So the defensive things were laggards. The growthier, tariff-sensitive stuff were the leaders. Mike, do you care that we're starting to see names like NVIDIA, Avgo, et cetera, Broadcom rather, all start to perk up in this environment and start to kind of show that strength again that really helped carry this market last year?
Yeah, I mean, it's not surprising to me. I mean, right now with SMH being up so much, if you think about some of the stocks that got hit the hardest in the sell-off, it was those stocks, your NVIDIAs, your TSMs, your AMDs. And I think, if you're going to stifle anything, stifle what you want and tariff what you want, but I don't think it's in the interest of any large entity to stifle technological advancement. Maybe that's a crazy thought, but I was looking at TSM. I wrote a TSM earnings preview before their earnings. They had a slight little boost, but I was looking at some of their numbers. Like the first 3 months of 2025, they had a year-over-year increase of an average of 40% from last year to this year, even amidst the craziness we've seen. So I don't know. I think if there's going to be something that outperforms from here till the end of the year, I could see semiconductors, anything related to AI, but I think that's a pretty public stance. But I mean, like NVIDIA still is at 106. I would be more surprised to see NVIDIA stay below 100 than go back up to 150. So that's another public stance. I'm just so public, as Tom would say.
TSM is actually putting in a nice little break of its downtrend here, as are a lot of the semis after a day like today. Avgo as well, Broadcom breaking the downtrend from the January. We'll call it February-ish, but I have it drawn to the most recent swing eye here in April. Still, this is now the highest close that we've seen prior to Liberation Day, and it puts us back in the territory where last June we set these highs and treated that as resistance going into the fall. We had that nice earnings report in December. Here, support. Here again, resistance. So 185 or so, the point is that it's been a line in the sand, and it seems like we're starting to we're making an effort to cross that threshold again. Broadcom's there, NVIDIA's there. Mike, you wanted to talk volatility before all this, though, and I think this is actually a really good segue. Where the hell did the vol go? In the tech stocks, 16.7 IVR in NVIDIA after all of this. I can't believe my eyes. I saw this on the NASDAQ today. We're looking at teens, 14.5.
Yeah.
What does that say to you right now about the vol term structure looking into tomorrow and I guess moving forward?
Yeah, I think it's interesting. And I think if there's ever a time to use IV percentile, I think when the VIX goes to 40 or 50 or 60, like that's the time to use IV percentile versus IV rank, because it gives you a more clear extreme situation, because IV rank is absolute, where it gives you the absolute high, absolute low over the last year, and we've basically hit the high over the last couple months, excluding the August unwind of last year. So yeah, I think it's interesting. But at the same time, if you're looking at IV rank, you always have to look at IV too. Like NVIDIA, if you're looking to sell premium in NVIDIA with 55% going into earnings, I'm totally fine with it. Anything over 50%, totally fine with it. But like GLD, this was one of the questions we get in like the YouTube channel all the time, like GLD and TLT. I see GLD IV of 40, pretty high. TLT IV of 35, those were higher. But if you look at the raw implied volatility of these products, TLT in the 20s, GLD in the 20s, like I would still rather do debit spreads there. Even if IV rank was 100, if I look at the IV and I see that it's under 30%, it's just, you're still not getting paid a lot of premium to take undefined risk. So always got to look at both. But yeah, I think the IV rank of 16, going back to the NVIDIA question, just speaks to how aggressively high the IV got over the past couple of weeks. And now we're kind of coming down to the 50s, where without that spike, 50s in NVIDIA would have been a higher IV rank reading, I would assume.
What's your take on the shape of the curve? I just had that pulled up here a second ago and I disappeared it. But what's your take on the shape of the volatility curve now as it's starting to flatten back out and get out of that more extreme backwardation?
Yeah, I think it's definitely so if we go back into contango in the VIX futures curve, that would be something to keep an eye on because I know I said this before on this show specifically, you can't get back to all-time highs unless you're in contango. It's just not going to happen. So keep your eye on the term structure of volatility futures. But something also interesting with a lot of these equities, so like thinking of NVIDIA and even if you're Inspire, the Qs, the fact that you're still seeing really heightened implied volatility in the near-term cycle relative to further dated cycles means you're not going to be able to pick up as much of a credit when you're rolling out in time because the further out cycles don't have a high enough IV to offset the really high IV in the near-term cycle. Even though you're rolling into a lot more time value, it's not necessarily matched with implied volatility value. DraftKings was one we were looking at earlier, where DraftKings, like look at the expected moves in DraftKings in May relative to June. It's almost the same, but June has 3 times the amount of time associated with it. And the difference in premium between May and June is basically nothing. So all that said, I think if there was ever a time to tinker around with the 21-day mark and consider not going to June or waiting a little bit and to get that premium out, it's in times like this where you still have so much high implied volatility in May and so much premium in May that your gamma risk is going to be a little bit lower because that extrinsic value can offset intrinsic value losses more for you than if it was a lower IV environment where you're collecting more premium going out. But yeah, the VIX futures, tinkering on that flat line, maybe going into contango, it's interesting, but I think we'll stay elevated for quite some time. We've seen 100-point moves pretty much every day for the last couple of weeks, and until something seismic shifts, I think we'll continue with that.
Oh yeah, I guess one of the hard things I'm wrapping my head around here is if volatility has come in as much as it has, like an IV rank at 27.5 is basically peanuts given where we've just been. Vol could still come in more and stocks may not rally, but you also could see a world where stocks rally and realized vol continues to outpace implied vol because of where's the VIX right now? Where we close out today? 26 and a half, basically. I mean, right, Mike, we're pricing in just a little over 1.5% daily move. So if we keep ripping off 2.1 or 2.8% daily moves, realized vol is going to be outpacing implied vol. If you had to place your chips on the table, you want to be directionally long, short stocks. Would you rather take the perspective that you're looking for vol to expand or just for stocks to fall backwards? Because volatility, again, once we get normalized into the environment, volatility can fall back even if none of the problems that have now come up have been resolved, like, businesses that may be shutting down because of supply chains that have been wrecked.
I think if you're going to make a bet as to what vol is going to do here, very near term, I think you look at this and you say, okay, we're going into a Friday. There's tons of weekend risk in this environment. There is always a tweet, seemingly, or a press conference or some such thing. And so you obviously have a big contraction in vol today, and there's nothing really on the economic calendar that should get anybody that much new information between now and the end of the week. So just the defensive-ness of people saying, I don't want weekend risk, might see any kind of a tactical exposure that was laid out today come back in. And so I would surmise that vol is likelier to expand, at least tomorrow, going into next week, than it is likely to contract further. More generally, sort of beyond the very near term, I think it is perfectly reasonable to say that we are going into a place where stocks grind down even as vol comes in, and the magnitude of these moves becomes a little bit more normal. So I think if you look at what vol did in 2022, that's a really good sort of barometer, because obviously that was a long down year for markets as the Fed was raising rates, but it wasn't chaotic. It wasn't a panic. It was a kind of stair-step down adjustment where markets digested what the Fed was doing and rode a ride for about a year. If what we're looking at here isn't the end of the financial system as we know it, because we've undermined the dollar and we've undermined the Treasury as a risk-free asset globally, and it looks like we're stepping back from that. We were flirting with it perhaps this month, but we've since backed away. If that's going away, what doesn't go away is the recession that comes when you increase tariffs from an average of about 2% to an average of about 10, with all the reprieves and blah, blah, blah. So, and the PMIs obviously are telling us that the conditions economically are awful, that we have the weakest growth in 16 months. We have analog readings pretty much anywhere you look. I mean, take a look at the Atlanta Fed GDP Now model, never mind the level, look at where it's pointed and see that it's fallen off a cliff, and that tells you the tone of the data that's gone in, sort of shaped the model. So when you look at the upshot, maybe the kind of brinksmanship that we've been seeing since the beginning of the month that got the market so unnerved is fading, and that's why bonds are up, because as we've been talking about for a few days now, the blowing out of term premium has been the reason that bonds suddenly crashed at the beginning of this month. Mm-hmm. Maybe that's coming in, and sort of the level of existential kind of sovereign risk uncertainty is coming in, but the recession is still coming. None of that is any different. And so you could go to a more normal bear market where the moves are gradual. What you sort of saw, let's call it late February into early March, a kind of slow bleeding out, rather than this kind of more hysterical move. And I think that we're back to the bottom of where that bleeding out started is very telling. We've basically reset all of the, oh my God, the US is going to destroy its own empire from within level of concern to there's a recession afoot. And the price action reflects it.
You know, that even if we are following a path where we're potentially getting out of, the worst of the fear stage, there's an interesting analogy here where if we do get this, we got this wide breadth thrust today, maybe this action is more like what happened in 1998, right? Where you get a market that gets spooked, has a significant pullback, and then we finally get through it. I'm going to pull up the price action analogy here for what happens in 1998 during the middle of that year. And we'll just take a look at how this path unfolds relative to recent price action. It would mean that if we followed that similar path to the 1998 analogy, and we've had, again, similar market sentiment around crisis, it would mean that we do have one more swing to the downside here, but it would call for a resolution back to the upside over the next few weeks and months. By the summer months, we begin to recover and ultimately we trade higher once more. So, look, I've seen a lot of different studies in terms of how the price action's unfolding, because you really can't rely on economic data right now. You can't rely on whatever the Federal Reserve is saying right now. Ilya, when was the last time you saw any of these individual Fed speakers like Goolsbee or Williams make a dent in the market? It's been Powell or bust, right? Yep. So you can't really rely on history or model out what's going on right now. So from a technical perspective, technicians believe that price action is a reflection of human psychology. Human psychology hasn't changed all that much in recent years, right? Evolution takes a long time to make its way through the system and the species. So the charts that we were looking at 5 or 10 years ago, probably people were feeling the same things with higher highs and lower lows as we do now. So maybe we can rely on studies of past price action to see if there are similar moments where it unfolded in such a specific manner. I've seen the 1998 analogy thrown around a lot. The Zweig breadth thrust would add a little bit of credence to that from that perspective. And quite frankly, the price action path that we've been following here, it kind of feels similar in terms of how this pullback has unfolded. So I'm not putting my eggs in that basket right now. I'm not exactly getting uber bulled up here. I have been writing out a short put spread that I was goaded into on March 14th. It has been a freaking nightmare. But you know what? 28 more S&P 500 points and I can get out of the break even. So I just need a little bit more.
Turn those thrusters on, baby.
Just 27 more points, please. Okay, but we got to talk about what happened in gold today. I was very content yesterday, Ilya. We had a pullback. I've been having trouble squaring the circle all day long. If you look at stocks and bonds, based on what happened yesterday, you would have said, oh, the dollar must be bouncing back more and gold must be getting hit again. Yeah. And then if you only looked at the dollar and gold today, you probably would have said, oh, geez, bad day for bonds, bad day for stocks. Something flipped back. And yet, obviously, that's not the case. So who's telling the right side of the story here? Is it the bond market and stocks, or is it gold and currency?
To me, it's that same thing we were talking about yesterday, where you have to sort of consider which market cares about what in this environment. Gold and the dollar, at least in April, let's say, seem to have been more of a reflection of, oh no, the empire has decided to self-immolate. And when you look at the moves in the dollar alongside the moves in the bonds, alongside the moves in gold, I think that really tells you a story. Notice that what was happening in particular with the bonds and the dollar, let's say January until the beginning of this month, it all looked very normal. Stocks, as ever, were late. Stocks are biased higher, and so it took them a while to really see the economic data. We've talked a lot about stocks didn't get spooked by the concept of tariffs. They got spooked by the rollout, as it were, starting to appear in business and consumer confidence, and that's why stocks ultimately caved in. But gold, bonds, dollar, they've been more on a, if you lift trade barriers, foreigners have fewer dollars to recycle back into the system, you're undermining sort of the architecture of the U.S.'s what's called the exorbitant privilege. This idea that the trade deficit is actually an asset for the U.S. Because on the flip side of the trade deficit are foreigners with giant piles of dollars that they have no incentive to repatriate back into their countries, because that would hurt the dollar, and if it hurt the dollar, it would hurt their own ability to sell to their U.S. consumers. They don't want that. So they reinvest that back into U.S. assets. There's a very long-standing inverse relationship between what happens with cash inflows into U.S. financial markets and the trade deficit. The wider the deficit, the bigger the inflows. So you have, I think, in gold, in the dollar, in bonds, a kind of more return to normal thing going on today. Bonds are up, dollar's a little bit down, gold's a little bit up. It seems like a kind of unclenching, where, again, you're sort of backing away from this idea that the empire is going to set itself on fire and break all of its own advantages. In my mind, it doesn't look to be over, but it's basically decision time. I mean, look at where gold is here. It's basically back to former resistance turned support. The euro looks almost the same. The yen looks almost the same. Bonds look almost the same. It's happening across the board, everywhere. So we're at a point of decision.
Yeah, I woke up this morning and I saw immediately said, my first instinct, God, this is screwing me so much. The first thing I woke up this morning wasn't like, oh, lean over and, kiss my pregnant wife, see how she's doing. It wasn't like, oh, go to the bathroom or wake up my daughter for school. It was, what did China say overnight?
Yeah. Yeah.
Oh, the mind of a trader.
Yeah.
So I saw these comments today. Chinese Ministry of Commerce spokesman He Yadong said reports on developments and talks are groundless. The Chinese Ministry of Foreign Affairs spokesperson Guo Jiakun said fake news. So when I saw gold doing what it's doing, it's like, oh, this is like, well, I'm not surprised. Trump's always saying things, right? If you're surprised that Trump is saying things,
always a tweet.
Like there's always right. Okay. So but you have to bake it in. He's going to exaggerate whatnot. But so I say, okay, this is why gold's up. Let me just go down the list now. So gold's up, the dollar's down. Okay. But why are bonds up? Why are stocks holding up? So kind of just waiting all day to see how that played out. And ultimately you could see bonds right now. They are still holding up. I think at least for the time being, Ilya, the Trump put theory and TLT versus SPY is thus far valid for the time being.
Yeah.
4.5% in the 10s, 5% in the 30s. The administration has shown a clear pain point around those. And if you're trading around the corresponding levels, 112 or so in ZB, 109 or so in ZN in the June expiries, selling puts against those levels or expecting directional neutral top has been a way to play it. Mike, we talk about volatility getting sucked out of everything everywhere. Except for notes, it's still a 50.7 IVR, which I find really fascinating. I'm a short iron condor here. I'm curious if you have any perception about what's going on at the long end of the curve. Ilya, Dylan, and I have our, macro maniac theories that make for good stories. But I'm curious from the vol perspective, do you find the lack of contraction in treasuries eyebrow raising relative to what their equity counterparts are doing?
It's a tough one. I wish I had the absolute figures, because sometimes with products that have single-digit implied volatility, the IV rank readings can be much more aggressive on smaller moves. But yeah, I think when you look at what's happening here, I mean, the fact that this thing has a single-digit implied volatility is kind of laughable, considering the volatility, the realized volatility of the price chart of this. But I mean, it's wild to see the 10-year, 2-year. I mean, really, I haven't even talked about or looked at the 10-year or 2-year until the last couple of weeks, and we're seeing those things fly around as well. So maybe this is. It's weird to say, but maybe this is one of the more volatile markets relative to IV compared to equities or even like gold. Like gold, I feel like has just been ripping higher with still low-ish implied volatility. What do you think about that statement? Is notes the place to be?
I mean, just we take the Liberation Day stuff out of the equation. We're trading right where we were throughout March. I got to find a better expression to use, guys. It's like, oh, if you go into a coma and you woke up now. But I don't have a better phrase, so I'm going to use something like that. If you went into a coma the first week of March and woke up now, and you were worried about Trump's trade wars, and so you put everything into 10-year notes, you're feeling pretty good. They've served their purpose.
Yeah.
Yeah. They haven't made you money, but you're not down like you'd be in stocks. So you're going to be up like you're in gold, but like you're hiding out in treasuries and they're holding the line. Ilya, is today's action and notes the sign that you mentioned the recession trade coming back in, less hair on fire, more garden variety recession playbook? Mm-hmm. Is the note action today? Is that what this is? What it's all about?
I mean, the note action is interesting, but I think ultimately the technical expression and the price action expression is more interesting at the long end. They're similar moves, but if you look at where ZB is relative, it's just a more interesting level, I think. The upshot is the same. We kind of fizzled back to the bottom of the kind of first test of Trump put range, and now we're at the top of the Trump put range, because it seems like there's something there at like just above 112, let's say, on ZB, and you've seen it hold now. You saw it hold, but by the way, it's the swing low from February, which is interesting. But you're holding right there, and you're at the top of the range. I mean, it's a little bit of a cleaner former support turn resistance in ZB than it is in ZM, but the upshot is exactly the same. So you look at this and you say, all right, when term premium numbers are updated next week, because there's the math that goes into this. It's usually a few days delayed in whatever sort of data provider you look at, unless you're fancy and you have a Bloomberg terminal or some such thing. For those of us that look at these things on publicly available resources, it's usually a day or two lag. So you look at this and you say, all right, well, what has happened? Maybe there's a trade deal with China because the Treasury Secretary is saying that the current situation is untenable. And yes, from the China side, they're saying, okay. Hold on now. Nobody's rolling over. And that's fine. That's a negotiation. But it's a different sort of mindset that the administration seems to be signaling, assuming the president is of one mind with Scott Bessent's comments, which is a big if, because the president has changed his mind a lot. So if you take Bessent's comments at face value, maybe there's a trade deal with China because the status quo is untenable for all involved. And what you do hear from the president is he's not going to attempt an extrajudicial firing of Fed Chair Powell. Okay. So again, the sort of empire self-immolating idea is fading. So maybe the term premium is coming out of the bonds. And that's why you get yields coming in, bonds coming up. This to me is sort of, you see it all over the place. But then the next thing is, but the recession. An orderly recession, maybe, but a recession nevertheless. And I've been saying for weeks that the way all of this ultimately resolves is you get back to a normal response to an economic downturn. The Fed cuts rates, bonds come up, dollar weakens, stocks weaken.
People just like stocks, though. Maybe that's all there is.
They do.
People like Mike and myself we kind of just like the stocks, and
we want to see them go up only.
When at the beginning of April, all of last year's rally was erased, I was looking at it and going, see all that time I was bearish last year? There. It's all gone.
Yeah. You could have been bullish the whole time and then got off the trade in March.
Yeah.
It is wild though, the mental, the shift in mentality though, because like it's like the meme where people are like looking at Bitcoin, the price of Bitcoin at like 80K, and they're lining up to go buy it because of FOMO, and then they see it at 60K and there's nobody in the line. It's just like, that's how I feel. Like everyone's like, no one was willing to buy a couple weeks ago these stocks that were at 30-40% discounts that had erased multi-year just massive moves to the upside.
Yeah.
Well, speaking of Bitcoin here, Mike, I came into this week pretty constructive on it. It seems like, last week kind of scared me when you started seeing gold and Bitcoin going up and the dollar going down and stocks going down. Like, wait, isn't Bitcoin supposed to be a high beta NASDAQ? Oh, no. It really is a safe haven now. Okay, so it drops into like the 75K. It has a little bit of a bounce there. The former highs from last March. Now it's breaking its downtrend. I've had this arrow drawn here for a few days. I think it's ready to lift off. What's your take on crypto at this juncture?
This has been the most quiet crypto period. And what's crazy is like we've been talking about IV rank. The Bitcoin IV rank in the futures is -2, which means that the current implied volatility is setting the new low for the year. Which I guess isn't that surprising because Bitcoin is one of those unique products like volatility products where the volatility increase is paired with an upside move in Bitcoin, not a downside move necessarily. Where like the S&Ps and NASDAQ, the volatility increase is paired with a downside move. So yeah, I think it speaks to the hodlers out there that just refuse to sell their Bitcoin. They're listening to Michael Saylor whenever the markets are going crazy. Michael Saylor tweets, "You do not sell your Bitcoin." Like, it's just insane. Speaking of, MicroStrategy just continues to pile on Bitcoin. I think they have, what do they have now? Over 500,000 coins.
He's feeling pretty good about it because Bitcoin has, this is, I think, when the quietest 25% rally off the lows Bitcoin move that we've seen. And it's happened in the span of 3 weeks. We hit we hit the low on April 7th at 74,434. And we are up 25.73% since then. And it feels like no one is talking about that at all. So Bitcoin quietly put it in that work every day, guys.
Yeah. It's one of those assets that'll continue to be volatile, and MicroStrategy will continue to be just a lever puller. Like MicroStrategy now has over 500,000 Bitcoin, and if you see Bitcoin go from like let's say 94K to 104K in a week, just a 10K rally, MicroStrategy you could see just have a huge tail to the upside, like it's like you saw back in October, November of last year. But we need to see that magnitude first.
Would you prefer to? Oh God, are we going to buy some out of the money MicroStrategy calls?
Oh my God!
Well, it's a beautiful thing, and they're expensive as hell. But so the beautiful thing about MicroStrategy and like VIX calls too, VIX volatility calls, it's the same kind of idea where if you buy a naked call in MicroStrategy. Or IBIT, for example. IBIT is a much lower price product, safer to invest in terms of not losing substantial amounts of money if you're wrong. But the nice thing about Bitcoin calls or products on calls and products that track Bitcoin, let's just say, if you know that when Bitcoin makes huge moves to the upside, that is also paired with a volatility increase. That's when you can really get paid on those out of the money calls that are not covered because you have the increasing stock price that increases all extrinsic value around it. You have the gamma increasing your delta as it goes up, and you have the implied volatility boost, all just increasing all the extrinsic value. So if you look at a price chart of like any out of the money call on IBIT or MicroStrategy, it is significant returns if you can time it. But MicroStrategy, IBIT, Bitcoin futures all setting new lows in implied volatility. So there hasn't
Look at
really
that
been there hasn't been a cheaper time to do it in that lens. So, but yeah, even without it, like IBIT's my favorite product to trade this year. It's my year-long trade. I have a 55-60 strangle in there. I've thrown on butterflies and whatnot, but I started the year with strangle for $565, and I've acquired almost an additional $1,000. So it's April 24th right now, and I have a $1,400 credit with that strangle. So it's been a really nice trade, and it will continue to be a nice trade as long as we stay in this like 50-60 range.
Looking at a call spread in IBIT with a negative 36.4 IVR, long 60, short 65 would be a play back to the highs effectively, and that would track with what Bitcoin may be doing as we look to that continuous futures chart right now. Bitcoin going up this week, holding its ground, even though stocks were down, Bitcoin's up, stocks are up, Bitcoin is staying up. Narrative flexibility is emerging for it once more. Love narrative flexibility for an asset. It's the most important thing that they can have. It's one of the reasons why I don't like the dollar, Ilya. It has narrative inflexibility. Yields down, interest rate differentials against it. Yields up, sovereign risk. It's a huge problem. But we're not going to be able to solve that this week because overtime is out of time for this Thursday and for this week. We'll be back on Monday, per usual. And Dylan will be joining us again. So special thanks to our guest, Mike Butler, continued overtime champion. For Ilya Spivak in San Francisco, Mike Butler in Chicago, I've been Chris Vecchio in New York. We'll see everyone, at least Ilya and I, tomorrow. But he's back next after a brief break for Macro Money.
See you there, everybody.
Steve in Atlanta, thank you so much for holding.
My pleasure, guys. And let me go on record as saying I think you've got Tasty Trade is the best brokerage, and you guys have the best content, and I'm not here just schmoozing. Y'all are the best on the planet, period, for what you do. Go on record as saying that. Tom,
Thanks.
You were the great disruptor when it came to forming Thinkorswim and then Tasty Trade. You're an innovator.
I appreciate you calling in. Good stuff as always. Thanks, man.
Diversify your portfolio with stocks, options, futures, crypto, and more. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Tasty Trade. Download today.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and tastylive web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more. From Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
If you missed the live show, here's our cherry on top weekly recap.
Vanetta, welcome home.
I have been trying to wear this outfit for the last 6 days. I thought I had the next 4 years off, honey. I was looking at property in Boca.
You still get Easter bats. I'm not getting one because we would get one for Nick and Gina and Sasha. They're all in their 30s now, and Chandler's 30. I mean, I'm not getting them anymore.
But no, if you have older kids, it's nice to know that you're thinking it. Like, Nikki would love a DraftKings gift card.
Get him a basket with the stuff hanging out in chocolate.
DraftKings gift card for Nikki would be a waste of money.
No, a DraftKings gift card for Nikki. That's a good basket. And some Zins. You put some Zins in there. and some Prime energy drinks, a DraftKings gift
I got
card.
one of those in the.
Yeah.
Do we record the breaks? Because that would be good. We could do like words of wisdom. We could do like a words of wisdom
there
bomb.
would be nothing good about recording those chats.
Occasionally we leave a mic open by accident.
I know that.
Yeah,
that's always fun. A hot mic. Yeah.
The thing is that I really like is every time Scott comes on, I love it because I know that everything's right with the world when he says, more importantly.
More importantly. I gotta ask a question. More importantly.
That's his favorite catchphrase. And honestly, it's got to be a Tasty Trade t-shirt. More importantly,
I agree with you. More importantly, it's going to have to be a t-shirt. We're going to get one of those made for sure.
Get the full scoop by checking out the archives at tastylive.com.
So you're an active trader, looking to increase your return, decrease your risk, or quite possibly both. Sure, you've heard of the Greeks. You know, your deltas, your thetas, your vegas, your charms, your vamas, etc. And you're wondering, hey, how do I use these guys to improve my risk-return relationship? Well, join me for a 10-episode crash course, and I'll show you exactly how to do it with all the gimmies and gotchas, one Greek at a time. We'll see you there.
The churn in the financial markets continues. There does seem to be a little bit of an unclenching in risk sentiment. Bonds up, stocks up, the U.S. dollar idling. That follows some perhaps, maybe, possibly moderating rhetoric out of the White House, but the upshot of the situation broadly unchanged, and the key markets still at key decision points from the beginning of this month, and we'll have to figure out what the price action is going to tell us about that. So in the meantime, we are going to take a look at a broader view of what may be going on here, and get back to our conversation about the diminishing confidence in the U.S. dollar, or so it would seem. We talked about why the current environment has been so negative for the U.S. dollar, as we've seen a kind of sell everything U.S. related kind of a dynamic since the beginning of this month. We've obviously seen stocks go down in the U.S., bonds go down in the U.S., and the dollar go down all at the same time in what has been a little bit of a change of pace, the dollar seemingly losing its capacity to rally as a haven on risk-off momentum or on higher yields. Those yields, of course, going up for the wrong reasons, but nevertheless. And so it bears asking, well, if not the dollar, then where? And if the currency world is not through its readjustment on the dollar, then where is there more room for this to continue? So we'll start this conversation here with a relationship that really illustrates why the dollar probably has more room to go down, even as we consider a kind of maybe preliminary unclenching of the issues that we've seen sort of hit the headlines and break out into markets. So this is a chart from the American Enterprise Institute, and it nicely distills what is the relationship between the U.S. trade deficit, ostensibly the thing we're trying to defeat with these tariffs, and its actual implications for what happens with the U.S. economy, and consider that actually what this is effectively a benefit and not a cost. And so consider here that what happens when this trade deficit is incurred, and that's the light blue line here, what is essentially occurring here is an outflow of dollars into the hands of foreigners. And that sounds bad, but consider actually what we're saying. Foreigners end up with a bunch of dollars having sold Americans primarily goods. That's generally where most American imports are. We take care of our services demand via domestic firms for the most part. So, and we're net exporters of services, actually. So, on the goods side, we're, of course, net importers by a long mile. And what that does, because clearly nobody's getting on a plane to buy their made in China or made in wherever stuff, they're buying it at their local store here in the US. So foreigners, and of course they end up paying for it in dollars. So we're simplifying supply chains for the benefit of the conversation, but the upshot here is foreigners then end up with a giant pile of dollars. And the question then becomes, well, do you convert those dollars back into local currency and invest in your own economy, or do you keep it in dollars? And what has been happening, basically going all the way back to the dawn of this system, which follows the untethering of the dollar from gold in the early to mid 70s, is this idea and this understanding on the part of our trading partners that if they were to convert that pile of dollars in size back into their local currency and repatriate that money, what would happen is the dollar would, of course, fall, because that would amount to selling dollars. Well, and then the purchasing power of their consumers in the U.S. would go with the dollar, and they wouldn't be able to buy all those exports anymore, not nearly in the same size or volume. And so what has happened is a recycling of dollars back into U.S. financial assets. That, of course, is a huge benefit for the U.S. because, number one, it is a huge inflow of capital into U.S. equity markets, which helps finance U.S. corporates. Number two, it is a huge inflow into U.S. Treasury securities, which helps keep interest rates low for the government and for all of the consumer lending rates and business lending rates that use treasuries and treasury yields as benchmark, which, surprise, surprise, is nearly all of them. So what you're looking at then is the upshot of the current account deficit being cheaper U.S. borrowing costs, higher U.S. stock markets, better capitalized U.S. corporates. And of course, since most pension money is basically just market tracking the S&P 500, that's a benefit for everybody involved, even for, let's say, public sector pension holders. Indeed, the largest holder of U.S. equities is CalPERS, the California fund that manages the money of public sector pensioners. So you have a situation here where the halving of the trade deficit, that is more open commerce, and the thing that we're attempting ostensibly to fix, as a mechanism for putting dollars in the hands of foreigners that they then reinvest in the U.S., that, of course, makes the U.S. dollar stronger. Now, lest you say, well, this is only through 2015, a decade has elapsed since, surely this situation has changed. Well, not so much. Here is a view that updates at least the trajectory, and of course these are different magnitude things because we're not dumping all of the sums that are embedded here into this. We're just looking at the direction of travel for the theme. And you can see here U.S. foreign direct investment since the end of the pandemic has surged, which of course has been finding a mirror image in a widening U.S. current account deficit. Not surprisingly, of course, the U.S. economy has been the one that has grown most robustly of the majors. We've seen that time and time again, and you can see that again more recently. More foreign direct investment, even just in the past several years, and a steeper trade deficit. You might take issue and say, well, look, these magnitudes are different. This is some sort of chart art situation. Does this really hold? Well, again, these are not full aggregates. They're meant to show not the perfect relationship, but the trajectory of the theme. But let's take a look at the latest numbers from the U.S. Treasury Department and take a look at the sheer size of foreign holdings of U.S. securities, be it short-term debt or long-term debt or equities. And consider that this is in the trillions of dollars. So we're looking at somewhere in the neighborhood of approaching 30 trillion. Let's be generous and say it's somewhere between 25 and 28, something like this. And you can see that these numbers have steadily grown, and indeed since the pandemic they have actually become more dramatic, which of course is exactly what we find right here. So the essence of the relationship very much holds. And so it should not be any kind of a surprise that since the beginning of the year, as we were about to get an administration that very clearly presented itself as minded to close the trade deficit and to become generally more protectionist, that what you would see is a situation where the US dollar would weaken, because if you reduce volumes of trade, be it with tariffs, be it some other way, of course, in this case it is tariffs, if you reduce the volume of trade, then you reduce the amount of dollars that foreigners hold. And then this dynamic starts to cave in on itself. If they have fewer dollars, then they have fewer dollars to reinvest. If you give them a reason to be concerned about reinvesting those dollars, then maybe they will be more inclined, especially if they anticipate that volumes of trade downwind are going to be reduced and there's less of a reason to want to keep the dollar uplifted for purchasing power of your exports, because what the U.S. has done is basically blocked those exports before that's even a consideration. Well, then you might have an exodus out of the U.S. dollar. And indeed, as we see here, this is a chart of the U.S. dollar index, which is an average of the U.S. dollar's value against its major counterparts. And needless to say, I've decried the limitations of this thing because it was constructed before there was a euro. And so all of the legacy currencies that used to make this a diversified basket are now essentially the euro, and this might as well be then the euro-US dollar exchange rate upside down. The basket doesn't include a China proxy like the Australian dollar, which at this point is the fourth most actively traded currency, according to the most recent data from the Bank of International Settlements, which we'll take a look at in just a second. But nevertheless, the thematic implications of what's going on here, those hold. The upshot of saying to the markets that we are going to try to close the U.S. trade deficit, and the way that we're going to do it is we're going to erect trade barriers that make it less attractive to buy from abroad. That's going to weaken the dollar. And the reason it's going to weaken the dollar is because this recycling of dollars from the trade deficit back into the U.S., that sort of process will be fundamentally undermined by trying to close the avenue by which foreigners end up with those dollars in the first place. And then, of course, comes the question, well, okay, so what then is the next step, and which currencies might you then expect to benefit? Because, again, that money has to go somewhere. Things are still going to be sold, but maybe there's not a reason to dump them back into U.S. markets, and maybe the volumes are less U.S. versus rest of world, but rest of world still has its wares to sell. And so capital is going to go, it's just not going to go into the U.S. So then which currencies ought to be the beneficiaries if the dollar is going to lose some of its quote-unquote market share? And as promised, here are the latest numbers from the Bank of International Settlements. They are as of 2022. That's the last update. They're on a triannual schedule, so we should get another update of these numbers this year. But as it stands, this is where we are, and these things are not terribly volatile, so this is still quite an accurate reflection of current reality. And you can see that the next most liquid currencies after the dollar are the euro and the yen. And of course, we can see the drop-off is absolutely staggering. And lest you think that the BRICS, which I've made into a grouping here, lest you think they're in contention, just consider how absolutely minute they are relative to the amount of monetary transactions settled in the dollars, and also consider that they are just a touch above only China by itself. So really, this BRICS number minus China is barely a rounding error and barely even visible on this chart. I mean, here's Brazil, here's Russia, India is over here, and China's right there. So we're talking about barely visible amounts of volume. And this is not really a contender. There is no way that you could shove anything like a meaningful amount of US dollar market share in terms of settlement payments into this. Now, when you combine the euro and the yen, you're looking at about 3.5 trillion. That's to the US dollars 6.6. So it's about half. So you might see, let's say, this big share of the dollar diminished down, let's suppose, halfway. Maybe, I mean, that would be catastrophic, of course, but let's say you could have room to reduce this by some measure, where the U.S. would be still overwhelmingly the dominant, because there's nothing even remotely close in terms of market size and liquidity and stock of assets to absorb all of this kind of liquidity. But you might perhaps see the tally here come down a bit and the tally here come up a bit. And of course, the problem with expecting the China tally to come up a bit is they don't have markets that are entirely open or even close to open. There are significant capital controls. Liquidity is non-existent in sort of any kind of practical sense, and it'll take a really long time to start to rival the U.S. in terms of financial heft, even though the economy is the world's second largest, just because of the way that capital is gated onshore. And so you're looking at the liquid alternatives where capital can move freely. And needless to say, the natural kind of alternatives that stand out are the euro and the yen. And with that in mind, it seems hardly surprising that those have been the two currencies that have outperformed against the dollar since the beginning of the year. These are percent change numbers for the benchmark futures for the top four currencies most transacted against the dollar. And you can see here it's euro, yen, pound. China's capital controls taken out of rotation. The next one is the Aussie. And those are the four that you see here. We can see the Aussie has lagged. The pound has lagged. The euro and yen have added north of 10% apiece. You might say, well, why are we talking about this now? There's already been a massive rally in these currencies against the dollar, and if anything, they're starting to pull back a bit. We were looking at gains of as much as 12% only a few days ago. Isn't this move over? Well, in my mind, that's the perfect time to be talking about this, because if there is some sort of a near-term correction in this, then what it offers is an excellent buying opportunity. And the time to think about it isn't when that buying opportunity has already appeared. It's when you anticipate and you can prepare for it to actually show up and have the capital and the key levels in mind to actually make that into an actionable thesis. Because indeed, this is not the kind of thing where the dollar sells off because maybe President Trump is going to attempt an extrajudicial firing of Chair Powell. This is not the kind of thing where you get an episodic response to maybe a trade deal with China, maybe not, depends on who you ask. If you ask Treasury Secretary Scott Bessent, the deal is inevitable. If you ask Chinese officials that commented overnight, nobody's talking to them and there is no substantive discussion and they have no idea what the White House is talking about. Obviously, we take both things with a grain of salt. It's a negotiation between rivals. They're attempting to paint the tape their way. So as we look at all of this, the upshot is, beyond these headlines, is there a structural direction? And I think clearly, as we see from the trajectory of the dollar going all the way to the beginning of the year, there indeed is. And we've gone up and down along the way here, but the trend is the trend. And what it reflects is this structural unwinding of these dynamics. And so, while the dollar may be done falling here in the near term, the trend remains and the structural underpinnings for it continue. In the most sort of hands-on practical sense, we still are looking at sizable interest rate cuts for the U.S. this year and next, looking at about 110 basis points at this point. Cumulatively, not surprisingly, that tally has increased significantly since all of this concern around the tariff rollout has hit fever pitch late February, let's say, up through now. The expectations have become increasingly more dovish. But against that backdrop, the situation in Europe is quite different. First off, we're looking at less of a tally, so less by about a rate cut than what we have for the U.S. But more importantly, theme-wise, we are starting to see over the recent months, really since the beginning of the year, the idea percolate that maybe next year is a year for rate hikes out of the Eurozone, which would only make the US dollar weakness argument stronger. Because, of course, then yield differentials in a very classic way would shift against the dollar. And this idea that maybe we're looking at rate hikes next year, this follows Europe's seeming conclusion that the U.S. security blanket is now unreliable and that NATO ex-U.S. needs to arm itself. And so there's been a dramatic push, especially in the Eurozone, to spend a bunch of money to rearm. That, of course, is going to be a boost to both growth and inflation, and the ECB is going to have to approach it as such. And so we've seen a sense show up here that the sort of rate differential that maybe favored the US dollar this year, however ineffectively, will actually invert on it next year. That, of course, is something markets might front run as the dust settles. And, of course, for the Bank of Japan, the story uniquely amongst the major economies has been of rate hikes. We can see on the bottom here the spread between the current implied futures curve, that's in the red here. It was a little bit more hawkish a month ago, but nevertheless, it still points to hikes. We can see the difference going into the back half of this year between the current target rate and what the curve implies is positive. That is to say, we are looking at rate hikes into the back half of this year from the Bank of Japan, and that really should be something that makes quite a bit of sense if you consider that we just got PMI numbers this week out of Japan that, unlike many of the other major economies, were blisteringly strong. And so the argument here still seems to favor a U.S. dollar that weakens as U.S. trade policy gets more protectionist, and the euro and yen as the likely winners from that for months and quarters to come, if not perhaps just right here. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'll be back with Chris for Futures Power Hour tomorrow, back with Victor and Tom for First Call on Sunday, writing for the News and Insights portion of tastylive.com, opining at Ilias Pivac on the platform formerly known as Twitter, and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money's back next week. Happy trading.
When somebody says tape action, what do you think of?
To me, tape action is a little bit of a historical term because that's how they used to relay the different information for all the different underlyings that you could trade. They would share like the price, the volume. So it'd be a way for people to kind of get a gauge for different markets. But now I just kind of think of it as that little line of information on your screen when you're watching your financial news outlets and seeing what all the different products are currently trading for.
What's a Johnny trader?
A Johnny trader is defined as Nick Batista and myself. We are smaller traders, smaller accounts, mid-sized accounts where we can't sling anything we want. We can't do multiple contracts of anything we want. We are really defined to specific parameters in trading in a small way. So a Johnny trader is just someone that might be doing one lots, one contract here and there, or trading smaller price products.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and Tasty Live web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
Dear Cheapo Airlines, thank you so much for sending my luggage on a magical side quest instead of my planned destination. I am glad that I had the sustenance of the single pretzel I was served on board while I was waiting for my bag to arrive. Looking forward to your reply, because surely the response can't be as delayed as long as my flight was. Warm regards, Bettina.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
Every day I do God's work here.
From the smart mouths at Tasty Live.
Oh, yeah. Tasty Nation, good morning.
What is going on, everybody, and welcome back to Risk and Reward. Another volatile day in the market, a lot of rips to the upside. We got Google's earnings. We got some things to talk about. We got a special segment for today. But before we get into that, Gus, my brother, how we doing today? I'm loving the light blue. I'm throwing darts in a dark room right now. I am a little colorblind, but I'm feeling the blue today.
That's a good analogy. No, it is light blue. It's kind of got some speckles going on. Nothing too crazy. I decided to sit on the really crazy shirts for 1 or 2 more Thursdays. I'm gonna have to up my stock there, but
they stand out too much. Yeah.
it's true.
Like you got to wear it once a month now.
Yeah. And the 2 I have left are loud, like visually loud. Like I got one that's.
I mean, they have to be.
One's got like it's like white and it's got cacti and like flamingos on it, like a whole deal. And then the other one is white, and it's actually like one of my favorite shirts, but it's more of a golf specific shirt. It's got like big cherry blossom flowers all over it. It's a little bit loud for the office, so I don't know. We're feeling it out, but I'll break out one of those bad boys. It has to be a celebration, you know. If I'm winning huge or something like that, if I got something to celebrate, if we're popping some champagne, I'll break out the fun shirts. Right. But no, feeling good today. I just mentioned to you pre-show, I'm up on Google, so feeling good about that. TNA trades I put on as risk of the week. I'm already out of for a profit, so it's been going really well.
What was that one again? Was that a spread?
I have 2 verticals that are longer term leaps, but that itself I just took I took a naked call, nice. I mean, almost 100%ed on it, like pretty quick.
I mean, to be directional with some of those naked positions too. I mean, this is the market to be directional, because I mean, we get a directional move, you might be able to capitalize on a pretty decent sized directional move there. Just like with today, I mean, the market was running all day, the momentum all morning. It was like, it's just not stopping. So was able to exit some of those positions. You did mention the Google position. What'd you end up doing in there? I know Dr. Jim nudged me into that one yesterday.
I have nothing too fancy. I just have been loading Google shares this entire time. We've been at the bottom, and now the pop has finally come through. So I have 21 shares of Google, which might as well be an options position with how much it moves when Google moves $1 at this point. But yeah, loaded there and sitting pretty. This actually was the final move to flip these Google positions red to green, because I was buying all the way on the way down. So happy about that. Lots and lots of my stuff flipped red to green today. If we get 2 more days like this, all of a sudden it'll be time to dump all these shares, free up a bunch of capital, and really get active again. So I'm excited about it, and my fingers are crossed. But in this environment, you certainly never know.
No, I hear you completely on that. Again, we'll see where Google stands by the time market opens. I know we got a nice rip to the upside, like 20-something points, but we never know what we'll get overnight and if it'll sustain itself. So we'll see what we get there on Google. We got more risks of the week. I know next week we will then start beginning to kind of just get it or have in mind some of the risks that we put on over the last few weeks, and then we'll go from there and kind of compare and see how some of these have kind of played out. But we got risk and reward today. Buy now, regret later. what is this title insinuating right here?
Yeah, man, it makes me think of the Drake album, Act Now, Cry Later. That's actually what I was thinking about all day today. This title insinuates BNPL. We're talking BNPL services, that being buy now, pay later, something that is growing rapidly in prominence. Most notably, last week or the week before, I believe 60% of Coachella tickets were bought on BNPL services, which is a crazy number. These services, they appear pretty docile at the surface level. You know, for interest-free payments sounds nice and easy. They're not particularly predatory, but they are dangerous, and we're going to get into why, where this market may be going, and how it could potentially affect America's economic future.
Yeah, I mean, 60% of Coachella tickets purchased on a BNPL service. Is it that serious? It's not nothing like Lollapalooza. I mean, if you're a Chicago local, maybe Lollapalooza, you can justify that. But Coachella is 60%. Does that surprise you? Before we even get into it, does that surprise you? That's a wild statistic. I don't know if it was just a headline grabbing statistic you throw out there where it has a lot of shock value, but 60% is nothing to sweep under the rug.
Well, yeah, it does. It does kind of shock me because the statistic that's being thrown around is in reference to these BNPL services specifically. Klarna, Affirm, Afterpay are the three biggest players in the market. And that's shocking to me because do you people not have credit cards? Like, right. I don't understand. It feels to me like a credit card is the traditional avenue for purchasing something that you can't afford in the immediate, but know that you will be able to pay off. Yep. And the BNPL services, especially because the payment plans aren't super duper flexible, as we'll get into here in a bit. But sometimes a credit card can even offer you more flexibility. So yeah, the fact that it's all being routed through these services is fascinating to me, and potentially means big things for their next earnings call if we're seeing these type of numbers on purchases that are this expensive.
Yeah, I know we'll get into more of the details here, and then some of those initial questions that rise in your mind, like why would somebody use a service like this over credit cards? Some of these details might draw a closer conclusion as to why people check some of these services out. But the first one, what even is buy now, pay later? It sounds exactly like a credit card would. So what's new about this? It's exactly like a credit card would be. But in terms of these installments, you can usually pay up to 4 installments. So you can buy now, pay later. So how does this even separate you from a credit card service? Like I was asking myself, why would even a retailer, want to be working with the buy now, pay later service over a regular credit card company? Like what is the incentive there? So those are some of the first things that initially go through my mind. But it's exactly how it sounds. Like imagine you want to buy a $100 pair of shoes, but you don't want to, or you can't pay the full price amount. With the BNPL service, you can. So you can pay $25 today and then pay $25 every 2 weeks in that 4 installment. And so you can get the whole thing paid off. So sounds exactly like a credit card. What is the catch? Affirm was one of the stocks that popped off. I think it was maybe 3 to 4 years ago. It was a buy now, pay later service. Affirm, I know that was one that was going wild in the options trading community. A lot of volatility, massive moves. But it sounds like these were catching headwind. I mean, just after 2020, especially, I can just recall some of those moves and those other underlyings. But yeah, it's nothing new under the sun, but they are getting a lot more popular as per some of the statistics we're going to be looking at here in a moment. So when did you first hear about the buy now, pay later service, Gus? And did you know it was becoming this popular or prominent? Like, why not just credit cards? Why this route?
Yeah, my timeline would be pretty equally ambiguous to what you just outlined. Sometime in college is kind of the best best judgment that I can give, which granted, I just graduated 4 months ago, I suppose. So sometime between 4 months ago and 4 years and 4 months ago.
I trust that anecdote because of that. I trust that. That's the freshest statistics, the freshest experience we could get. So we need to hear it.
Yeah, it's true. And so I don't know, sometime, I guess I would say maybe 2021, 2022 is when I started to first see these things pop up. And I don't know that I ever really saw them in the news or media or market news or anything. For me, it was just as I started doing transactions, and all of a sudden there's these extra buttons, these pay in 4 easy installments with Klarna.
Right, like another option.
Exactly. Yeah, you got your credit debit card, PayPal, and then all of a sudden Klarna starts popping up. So that was sort of what made me aware of this phenomenon. But I mean, as we're about to get into in this slide, it has just absolutely exploded. There's lots and lots of people using these services. I know a few people personally who use these services. I know one person personally who's gotten into some trouble, and we'll get into that later. It's very interesting, and it does offer an interesting alternative to credit cards if you have bad credit or have trouble getting approved. But what is also worrisome is that in the majority of cases, if you have bad credit, it's for good reason, and you probably shouldn't be taking out more loans. It's a double-edged sword. But anyway, yeah, as we get into here, it has turned into a global multi-billion-dollar market. Yeah, and as we outline here, and we'll get into this interest-free thing is a little bit nuanced, but in principle, if you're exactly perfect and on time with your payments, you really can just break these things into 4 payments. There's no additional cost to you as a consumer. You pay the cost of whatever item you may be buying, clothing, shoes, food, whatever it may be. And it really is just broken up into 4 easy payments that you can amortize over time. And yeah, online shopping, this is like a 2015 conversation to have here. Yeah. Online shopping is big, guys. Newsflash. Lots of people shop online.
You'd be surprised. You would be surprised, though. I would say it is so glaringly obvious now, but I would even say in 2020, it wasn't even that. Like, I feel like a lot of businesses didn't even have an online presence, even just 5 years ago. But yeah, just like you kind of said, guys, online shopping is here. It's here to stay. And it's very popular. But what were you saying on to that, guys?
I mean, yeah. And I mean, in my personal experience, I pretty much exclusively shop online. I certainly fit this Gen Z mold.
I'm so boomer for that, though. I'm so the opposite. For some reason, it depends on the item.
It definitely depends on the item.
If it's a clothing item, I hate ordering clothing items online. It's like I will avoid that at all costs. But anything else, I will, I just like to get the things right away if I'm purchasing something, especially if I need to know if it's an exact fit and if I'm actually going to need this exact purchase and if it's going to work for what I need it for.
Amazon is getting so quick now. I ordered something this morning at like 10 or 11 a.m. and it's going to be here by 6 p.m. today. So like once you starting to get into all this same day stuff and that infrastructure is only growing, it really starts to ease some of those pains for me. But I certainly agree, clothing, especially if it's clothing that I'm buying for the first time, I don't know the brand or anything about it. That can be really tough online. I actually have been stuck bag holding a Gymshark shirt that does not fit for like 2 years. It's still brand new.
Every time.
Yeah. So, things like that absolutely do happen. But the vast majority of things, and I religiously DoorDash and Instacart, like I'll get my groceries delivered. I absolutely fit this Gen Z mold of choosing convenience over saving a little bit of money.
Yeah.
Well, yeah, because, when these things, when you break it down, it's like, do I want to walk a quarter mile in the cold to the grocery store and then carry all my groceries back? Or is it worth extra $15 to me to not do that? And it just is. It just almost always is. So when you break it down from a value standpoint, I usually just find myself in that boat.
No, absolutely. That makes a lot of sense. And I mean, buy now, pay later services. I mean, what even is their main source of revenue? I know we got a lot of the interest rates on a lot of those credit cards. We got a lot of credit card fees. There's a lot of credit card fees left and right. But it's like with a buy now, pay later service, where are they even bringing in money? And as we know, buy now, pay later services, they charge retailers a fee, usually about 2 to 8% per transaction at checkout. And like you kind of just mentioned, you go to checkout, there's an extra option. It's almost like every few months, every quarter, there's a new option to check out with a different service or different provider, whatever's going to be most convenient to the user. And I think even after even when we really dove into like the e-commerce drop shipping space, like even though that was like so earlier on, it did teach you a lot about marketing. It taught you a lot about consumer behavior, especially on a website, and figuring out, any sort of way you can funnel somebody all the way down into the checkout process. And it just kind of sounds like this is another way for, a lot of e-commerce businesses to be able to take advantage and just capitalize on the convenience of offering whatever payment service somebody has at the time, so they're not missing out on extra revenue, whatever the case might be. But buy now, pay later services increases sales, as we can see right here on the second bullet point, increases sales. So if you're somebody running a website and you're trying to make things a little bit more efficient, if this is an extra option, I can see how they can be in the space of, why wouldn't I test this out? Why wouldn't I try it? If it's going to bring the overhead down, if it's going to widen profit margins, whatever it might be, it might make sense for somebody to test this out from a business perspective. But if a customer misses a payment, like, what is the catch? There are late fees. So as we know here, most of these plans are going to come in 4 installments. And if you pay within that time window, you don't have any interest to pay on whatever you were paying later on. But if you exceed that limit, maybe 6 months, 12 months, 24 months, there is going to be a very high interest rate that you're going to be charged on that. And it can be vary between 10 and 30% APR. So they can get pretty hefty, and almost more hefty than credit card fees whenever not being paid on time. But, if you do have good habits, Gus, who's to say that's not a better financial decision using there's a stigma to it already, but who's not to say? You don't got to pay any interest on here. And I know we're going to get into some of the pros and cons right now. But I don't know, man. That sounds kind of good so far.
Well, to me, it just comes down to why are you using this BNPL service in the first place? And if the answer is because I cannot afford the item right now, then it's just that is always empirically going to be an irresponsible financial decision. And that's true. That rings true also with credit cards. If you're spending money that you cannot pay off on a credit card, that is going to be an irresponsible decision that may come back to bite you. Yeah, I don't know. It's interesting. And the second bullet point is the most interesting one to me. This stuff, I remember reading a study about Klarna and Macy's some time ago, and Macy's found that consumers spent 30% more money when they were using a BNPL service, which just further, adds to that, because once you get through the checkout process and you see, oh, my payment is just, a quarter of the amount I'm spending, I'll throw a few more items in there. So that empirically absolutely does work, and people increase their cart sizes by a lot. These companies aren't just breaking even. They're making considerably more money by offering these services to people.
Yeah. So as we transition to this next question, just to go back and forth a little bit, why not? Why not the buy now, pay later services? This is a perfect slide. Some advantages and disadvantages. But I mean, let's say you were purchasing something that you were already going to have to purchase on a credit card. And it's like, I can use this service over here, and I don't even have to pay any interest on that. Not even if it's for a month or 2 months, I got to pay 0 interest on this. So why wouldn't I go with this? But we do have some advantages and disadvantages right here. So what does this lay out on this one?
Yeah, there are certainly advantages. I don't just want to broad scale shoot down these buy now, pay later services. There are situations where it might make sense. They offer interest-free payments, and as long as they're made on time, everything is good. I saw somebody really aggressively arguing in a Reddit thread earlier today as I was doing research for this, saying, well, but you could put the money in an asset that adds interest, and then you're making money while you're paying for the item. It's 8 weeks, bro. I don't know what really reliable thing you're finding. And also, how much money are you spending? But that's, meme stocks, things like that actually could go parabolic. You might as well just go sit down at the blackjack table. And if you're talking about like an actual safe interest producing asset, good interest producing assets are going to get you 4% a year, 5% a year, and actually, provide you with some safety. So when you talk about 8 weeks, and then also you talk about how much money are you even spending on this item in the first place? Is it $100? Like you might make 60 extra cents on your $100. So anyway, that Redditor, I disagree, but it can be useful in times of necessity, and I was thinking about this too. If you're, 2 days away from a paycheck and you need like food or something, then these services can really provide some utility. So I do think that there is utility here, but there are disadvantages as well. Most notably, and what makes a credit card better, in my opinion, is most of these BNPL services don't report to credit bureaus. So making payments on time is not going to help your credit at all. And if you miss your payments for long enough that they have to send you to collections, that is going to hurt your credit. So there is only downside in terms of your credit score when you use these services. Additionally, they tend to have higher interest rates. We kind of covered that on the last slide, but these interest rates can get pretty exorbitant. And I had to dig really deep today to even figure out what interest rate Klarna would start charging you, because Klarna front facing, they market $7 late fee. That's what they say. Like that's their blanket statement. Right. If you miss a payment, it's $7. And I had to dig and dig and dig before I could actually find percentages in their terms of service and figure out what their actual interest rate was. Because believe me, it's not just a $7 slap on the wrist. And they will send you to collections. And I'm sure that they have to from time to time because they don't do credit checks before they approve these loans. So you can't just run off, and there's only negatives to be had with your credit score.
Considering all of this information, it almost sounds like, because if you pay in those 4 installments, you pay in the time window you need to pay in, right? You're not going to have to pay any extra interest on those fees. But I'm pretty sure a lot of these buy now, pay later services still, bet on the fact that there's going to be human error. There's going to be people that are slipping up, and I think they recognize, those fees are going to come in on the back end, and, human behavior and natural habits we humans create, they kind of bang it on at the same time.
Reliance on the service, you can't pay $100 one time, so you do it in 4 installments, and then you can't pay $80 the next day, so you do it in 4 installments, and you repeat this, and suddenly you got $200 due every 2 weeks for the next 2 months, and it can really add up and make it a tough hole to get out of.
Oh yeah, 60% of Coachella tickets were purchased with the buy now, pay later service. And just hearing the headlines, it sounds like you can almost use these services for just about anything. But here are a few things that you cannot use for a buy now, pay later service. And the first thing is utility bills and rent, right? Sounds like a necessity. Yeah, but that's something that we're going to draw the line. It sounds kind of crazy. It's like, yeah, Coachella tickets, this maybe not so much, but that makes total sense, right? Most medical bills, a buy now, pay later service on some medical bills, you can get into some deep waters. Obviously, the buy now, pay later services want to take off as much risk on their backs as well. Investments, crypto, financial products. Sorry, Redditor, if you're tuning in right now, you're listening. I guess that stands firm.
Do you mean I can't take margin out of my Klarna account?
What do you mean I can't take margin off the margin on the Klarna account to put it in some crypto? So you can't put it in Doge. Forget about meme coins, the NASDAQ. The NASDAQ has went up about 1,500 to 2,000 points in like the last 48 hours. Used cars, private vehicle sales, nothing like that. High risk items, firearms, regulated goods, and things of the such.
You mean I can't Klarna weed at the dispensary? We used to be a great country.
Make it. Yeah, I know. We got to go back. But no, you cannot use it for these bullet points right here. But I gotta say, none of these are really surprising to me. It is kind of funny how the most ridiculous items that we can think of, like a McFlurry, right? I know you had mentioned that a McFlurry, buying a pack of gum at the store, it's like, oh, buy now, pay later, all you want. But these items, definitely not. But just about anything you can use it on, because this isn't a long list either.
Yeah, it's true. Utility bills, I would say, are kind of the only one that's shocking here. Rent is usually a bit more, but your utility bill might be like $100 a month. That one maybe, yeah. But I understand. And also, I'm sure Klarna doesn't want to have to form relationships with every single utility provider across the United States.
No. That'll get messy real quick.
Yeah, but people are BNPLing just about anything. This is the infamous buy now, pay later tacos. This was a tweet that was trending for a long time and has since been repurposed, and people will say they're buying all kinds of things, and they'll pull this screenshot. But I did track down the original. This young lady, she financed her $8.26 transaction at Wancho's Tacos. And she is, as you can see, one payment in with the next payment due in 2 weeks, 4 installments of $2.75. The bullet points kind of hit the nail on the head here. If you think Gen Z is too smart to fall into this trap, you're wrong. And this is my generation that I'm talking about. We are stupid, I promise you. And then, yeah, as you can see, I say we sadly are using BNPL to buy tacos, McFlurries, all sorts of other cheap items that you should never be financing in the first place. However, I don't want to just sit here and sound like a boomer, because I've seen the videos of the Burger King in the 90s when Burger King started accepting credit cards, and everyone says, "What? You're going to take a loan from the bank to buy Burger King?"
True.
So I don't want to completely rule this out.
He said, "Rrr."
That's how they sound to me. But anyway, yeah. And then, yeah, BNPL services, while interest-free, build bad habits of spending money you do not have. I just explained that type of hole that you can get into. My personal anecdote here, I have a mutual friend who really fell into the trap of using these BNPL services to buy things that she did not need with money that she did not have. And then she had to approach my mutual friend, who was a fellow economics major and is good with money, and say, "Hey, I need you to figure out my finances for me." And when they sat down, she owed something to the tone of like $800 or $900 per payment for a little while. And it was like this whole financial conundrum. They were talking about selling her car and how they were going to figure this out. But it was all just because over and over she said, "Oh, 4 easy payments of X," and bought the item. And when you do that, you don't really think about how that's going to drain your money moving forward, and how your consumption habits may need to change to be able to keep up with those payments, especially if you're living paycheck to paycheck. So it's just very vital to be sure that you're not falling into that cycle should you deploy these services every now and then.
I think it really depends on how good these Juancho's tacos are. Like, I think it really depends, scale of 1 to 10. If it's a 9 or 10,
maybe it was a necessity.
Justifiable.
Maybe it was a necessity.
It might have been. I mean, if Juancho's Tacos is buzzing how they're talking about it's buzzing, it might have been a good decision. But growth projections, 2024 market valued at about $36.5 billion, which is pretty massive. Approximately 86.5 million users in the US. We have about a 300 to 330 million total population, if I'm not mistaken, in the US. So just about a third or under a third. 2025 forecast expected user base to be about 91 million, which I would have expected a little bit more. I feel that's not the biggest jump, I think, from one year to another. That's just about 6 million more users a year. Not that they don't already have a chokehold on a third of the U.S., but we're still going to see a jump in expected growth, year to year on something like these services. But it also makes sense. And, next time I wish we had more data just on the broken down age ranges, like these kind of fall under. But either way, buy now, pay later services aren't going anywhere. And consumer behavior, consumer habits, whenever we're checking out on these online stores, e-commerce stores, I think it's just going to grow. I don't think it's going to stop growing. And if it lowers the barrier to purchase something, I think it just increases the convenience. And we already see with consumer spending or consumer behavior, anything with a level of convenience typically thrives. So we'll probably keep growing into 2030, 2040, and buy now, pay later services will be of the norm. That's the prediction.
Yeah, AI will be determining your social credits and approving you for buy now, pay later loans, man. Yeah, Theta Trader hit the nail on the head in chat here. It's basically a restricted credit card for higher risk customers. That is a good way to put it. But yeah, future impact, as Errol said, BNPL services likely going to continue to grow. There will be positive impacts of this: increased consumer spending, which leads to increased economic growth, better access to who knows what. I didn't put it there. I forgot, I guess. So we're missing something there. I think I was going to say lines of credit or something like that. But negative impacts, creation of debt cycles like the one that I just outlined with my friend, potential increased cost for consumers, and that's because these companies have to give a cut to Klarna, and so they may need to start making that up in the aggregate by raising their prices a little bit, which could increase prices for consumers who are not using these services. And then, the last one, most critically, BNPL loans are unregulated and can be kind of predatory. They know that they are preying on people who are in a tight spot and can't really afford these things. They know that their interest rates are crazy, crazy high should you miss payments for a certain amount of time. And as Errol said, while they act like front-facing, they're getting all of their money from these businesses, I know that in their boardrooms and on their models, they are pricing in the whatever percentage of people that are going to default on these payments and how that's going to affect everything and how they might be able to make more money to that end. So
exactly.
And honestly, these services are rooting against you. They do not want you to make your payments on time. They get their money on the front end from wherever you bought the item, and then they want to get their $7 or more on the back end as well. You best believe. So, it's a little bit predatory, but I threw a consumer credit card debt chart in here because we're already over $1 trillion in credit card debt, and now we just have this other type of debt that can start mounting as well.
Yeah. It is kind of funny because I know we have these negative impacts listed out for the buy now, pay later service, but if we really just swapped out the title for credit card services, most of this information could be pretty fitting, and you can almost use it synonymously. That's kind of funny whenever we look at it that way too, because credit card companies definitely are hoping on negative human behavior to really increase their bottom line. So it is kind of funny to think about it that way. But 60% of Coachella tickets were purchased with the buy now, pay later service. Is there a change in consumer behavior that we're seeing right now? Maybe, maybe not, maybe just in a different form, or maybe it's just manifesting in a different way as technology progresses. But anything else to add before we hop on out of here today, Gus?
Yeah, no, I wouldn't really say I had much else. And I think that's a great point, that these things could be very interchangeable with credit card services, and credit card services and landlords, their favorite type of customer is one that pays 1 day late every single month.
That's a mic drop to end that one on. But thanks for taking the time to hang out with us today. Again, next week we will be back with Risk of the Week. We'll be breaking down some of the individual underlyings that we've been putting on over the last few weeks. Check out how those have been doing. Google earnings is doing really well. We'll see where we're at whenever market opens up tomorrow. I know I'm long. I know Gus was long. I know Dr. Jim was long. So we'll see how we're going to be managing those positions into the end of the week. Tomorrow is an expiration cycle, so we will be having to manage some of our positions at 21 days till expiration. But that is going to wrap it up for today's segment. We'll see you guys later, and stay tuned for more segments coming on next. We'll catch you guys later. Peace.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
I'm AJ Rudolph. I'm a senior product manager here at Tasty Trade, and I just qualified for the World Poker Tour $5 million free roll in Las Vegas on Friday. So I've been playing poker for about 20 years, actually. I started just with friends. It was like 2005, I think it was, where everybody was like, yes, let's go play poker. There was a huge boom around poker. And I actually feel like that is coming back around again. Right now, there seems to be a lot of interest, and the fields are growing, and everybody wants to get in there, and everybody has a chance to win. That's kind of the cool thing about all of these big events. I feel really privileged that I have the opportunity to go and do this. This particular tournament is only 2,000 people. You cannot buy your way into it. You have to win in order to win your seat, and that's what I did. And so I just buckled in and played my game and really focused and won my seat. I'm a very aggressive player. I do rely very heavily on reading the players at the table. I think that's super important. To be a balanced player, you want to make sure you're doing the math, you're reading the people, and you're doing all of those things in combination with each other, so that way you're using all the tools that are available to you.
Welcome in Tasty CEO Tom Sosnoff, also founded Thinkorswim. Some call him the godfather of retail options trading. Tom, it's good to have you on. How would you be reacting as a startup founder to this news?
I'd be really pissed.
Yeah. as you should be, by the way. I'm glad you said it because I can't.
And this is how we think as traders. You're much better off, instead of trying to follow the trend or follow the fundamentals, you're much better off playing the role of a contrarian.
And what I really want to do today is kind of break it out of that box and make it what it really should be, which is about understanding and thinking about probabilistic, predictable outcomes, about quantitative strategies. True financial literacy is about taking risk.
There's a very thin line between opportunity and risk, but where there's the most noise, there's the most opportunity.
The second you believe that somebody knows something and it's not you, then you're dead.
Yeah, it's Thursday, April 24th, a little bit after 5 p.m. Central Time, the best time. You know what that means? It's time for Tasty Live's evening show, a little podcast called The Price of Truth, the show where we like to explore the incentives that govern your world. And we're getting our money's worth. Every day there's a new set of incentives to break down. Today is no different. More on that in just a bit. Before we get there, we should say what's up to the people. Shout out to everybody watching on tastylive.com. Shout out to everybody watching on Tasty Trade desktop and mobile applications. If you don't already have both, you're making it hard on yourself. There's no need to do that. Things are hard enough, don't you think? So head on over to tastytrade.com. Get yourself a big glass of desktop with a side of mobile. I don't know. Does it work? It'll work. But if you want to be part of the conversation, bing, that is on your screen right here. There's only one place to do that. That's on Tasty Live's YouTube channel. So head on over there, find the YouTube channel, and jump in, start bashing your phalanges, your metacarpals, your skull even against your keyboard, and just make random characters into the chat. That way we can spoof the Google algorithm into putting us in front of as many people as possible. Shout out to all of you in the chat. I got this big ass poll in front of me. Shout out to everybody in the chat. Lone, I see you, Theta Trader, Grumpy Mike, Michael Anthony, Emmett, so many more. Brian Watson, what's up? Brian, Doty. Favorite part of the show, my man, you made me feel special. I appreciate you. Soul Train, and so many more. I'd shout out all of you if I could, but I'm contractually obligated to say something of substance. So off, and away we go, my babies. The S&P 500 up 2%. If you didn't know, it was another Green Day, 3 in a row. Do I know any Green Day tunes? Ryan, do you have the microphone by chance? I don't know if you're able to come in here. Only do it.
Yeah, what's up?
Oh, he's in. Do you know any Green Day tunes? You beautiful voice of an angel.
American Idiot?
Let's do it. Can you take me away? Take me away with a little American Idiot.
I didn't realize it was a sing-along. I want to be an American idiot. That's about it. That's about all I got on that one.
Well, you know what? That'll work. That's all I really needed. Thank you very much, my good friend Ryan. Green Day, in honor of the third Green Day here. The NDX, what am I saying? The NASDAQ 100 up 2 4/5%. The Dow Jones up 1 1/4%. The Russell up 2%. Sorry, loud noises, Victor. That's what I'm talking about. Get the chat pumping. 2% pretty much across the board, which is in line, I suppose, with the VIX and volatility. The interesting thing here is they brought them in, right? We were saying yesterday, 32 VIX, where we were hanging out, that was indicative of expecting 2% moves on a daily basis. So you get a realized volatility move today of 2% plus, and what happens? They contract volatility. So realized volatility, you can make a case it continues, I don't know, what's the word I want to use? Outperform implied vol just to a small extent. But forward size VX 24 and change, a meaningful contraction of volatility. We had been, I'd asked Tom on Sunday, is the fact that we're sub 30, we were at like 29 and change, 29.5, I believe, in volatility terms coming into the week. I said, is that a small win? Because good God, we were just at 60. Should I be happy that vol's contracted to sub 30? He said, no, you idiot. No, you idiot. Long-term average is still 18, and this is still a high vol environment. And I said, I know. Thank you, sir. May I have another 26.5 in cash VIX. Let's take a look at that beautiful term structure, shall we? Still in backwardation. You know what I mean? It's like I could just take a picture of this beauty. It doesn't matter what level we're at. We're at 26, we're at 28, we're at 24. It doesn't seem like this bad boy wants to come out of backwardation until it gets confirmation that, relations, let's call it, relations between China and the United States have some sort of predictability behind them. And I don't think it's just that, right? If you've been reading, the great thing about Twitter, I think, is you can dive into the minds of people that are just, I was going to use an inappropriate phrase here, really deep into a particular subject matter. And I find right now the logistics subject matter is absolutely fascinating to me. This idea that after, quote unquote, Liberation Day or April 2nd, you effectively are on the clock for 30 to 45 days between all the shipping containers that go out of China, Beijing, and make their way over to LA, and then from LA to other distribution points in America, Chicago, Houston, New York. And I find it fascinating, sort of, I don't want to call it doomsday scenarios, but, empty shelf scenarios, which is certainly not great for Americans, especially in confidence or your economy and your supply chain at large. But there's this sort of logistics conversation that's happening there I find fascinating. Maybe we'll sprinkle more into that next week, but as we approach effectively like May 5th to May 20th, May 5th to May 10th, it seems like there are some that are very concerned about what supplies are going to look like in the store. I don't know if today's durable goods number, which was an absolute blowout number, I don't know if that is sort of an indication of how much of this has been front run, how much demand has been pulled forward into today to be able to perhaps keep stock in shelves or on car lots, whatever the case may be, for a longer period of time than maybe some are a little bit spooked about. I can't make that call. But it was a monster number. Can I pull it up here? I'll try to get that for you in just a second. But the other fascinating conversation, if I could just take a detour into logistics here for just a second, the other fascinating part of this whole discussion is what would happen in a world where, let's say, tariffs gets dropped instantly. You remember there was this point during COVID, after the COVID lockdowns, where they let you all out of your cages. They let everybody out. They said, all right, you crazy goons, you've got your civil liberties back. Go crazy. So what happens is, people go into stores and you start buying stuff and they bid the prices up really quickly. There's not a lot of, the supply chains weren't working for a while. You don't have the availability. So then when there's tension between available supply and demand, that tension is relieved through a bidding process and you end up going higher and higher in terms of price. And so the question becomes like, what would, as a thought experiment, what would happen if they just dropped them all? Let's just say that people are right, that this isn't just softening rhetoric in route to trying to find a sort of a path for conversation, and that conversation itself could be bumpy. But let's just say this is a straight off ramp that's being attempted to save face. Let's say that narrative is correct. I don't think that's true. I think it's going to be bumpier than that, but let's just say it's true. Tariffs go to nothing. Then you get a bunch of suppliers that are sort of rushing to put in all these orders again. Then all those orders have to get loaded onto these shipping containers and shipped. And then you could get this kind of similar situation. It was called the bullwhip effect that we had sort of during that COVID period. And where you're undersupplied, then you oversupply, then you become undersupplied. One has to wonder whether or not we could be headed for that type of situation the next couple months as well. I'm fascinated by the logistics discussion. Sorry for the off ramp, but I'll get moving into my world. Andrew Juarez says, logistics Twitter popping off is a great example of how trader groupthink gets wired into real world narratives and price gives way. Possibly. I think another way to look at it is, what is, from a trader perspective, what does, you listen to a earnings call because you want to understand what the C-suite is thinking about the current environment. You might listen to staples companies because you want to understand at the raw materials level, what do costs look like and what does demand look like, and I think tuning into different parts of subject matter expertise, you have to be careful on how you handicap it, but I think it can be valuable. Always. Bonds, my babies, up to 115. We finally made it emphatically to that 115 level. After just dumping to the 111, 110, I thought it was possible we could get to 115 to 117. I dumped that long exposure as soon as we got to 115. And if I'm being honest, I thought I took like a very short-term fade against bonds here. I wouldn't suggest it. I don't think it's going to work out. There's a part of me that thinks I'm a little bit too early, but I am curious how long this bid in the marketplace is going to last. We're on day 3 here of positive risk sentiment. We're now at 5,500, which was a previous sort of value area in the marketplace. If you'll look at my beautiful little chart I drew on with crayons. But 5,500 was effectively this value area. I had put brackets around that at plus or minus 500. We found a new value area, I would argue, at 5,000, but we've now back. We're at 5,500. So that massive discount in the market's not necessarily there. I thought we'd see a flattening in the yield curve. We have seen that over 2 days. Back to 115. Could it last a little bit longer? Sure. I thought we'd see a reversal in gold. We did. We saw a little bit of a snapback rally today. The The question is, do you have the stones to try to fade this again? I don't yet. I think what I did is I sold some upside calls today. So I think I sold the, I'll look it up here in just a second. Maybe the 3,500 was my short call with something else behind it, maybe 50 points or so. So if it blows through 3,500, it's gonna come find me. But today I did sell a little bit of upside calls. I did not go explicitly short as I was yesterday, the day before. I don't know that I want to play that game, especially with escalating Chinese rhetoric. I think, again, one of the reasons why I looked to fade bonds today was just my big question after the softening of rhetoric is what I'm framing it as, just for ease of terminology here. The softening of rhetoric out of the U.S. administration. The next point that I was going to look at was, what do you hear out of China? And on day one, which was yesterday, it was effectively neutral rhetoric, I would argue. Very neutral rhetoric, which could be interpreted either way. But in a world of people who are looking for positive news, for this thing to be de-escalated, it was very clear to me that it was interpreted in a best efforts, through the best efforts lens. Today, I would argue not so much. I don't think it was neutral. I think it leaned a little bit more hawkish. And ultimately, I think that's the worst possible scenario for the U.S. administration. If you get gold rallying, you get higher yields, and you get China that is not softening up their rhetoric after you sort of, you kind of did this public, I don't know what it's called. What's it called when the samurai sort of sticks himself in the stomach with a sword? There's a word for it. But if you kind of did this public, humbling of yourself and softening of the rhetoric, both from Scott Bessent as well as from President Trump, and if you don't get the desired impact, kind of worst case scenario, and I wonder what would happen in that world. But the commentary out of China here today was, if you're serious about this, you should remove all unilateral tariffs on China. Which led to, I don't know what it's called, a presser or something like this out of the U.S. administration today around afternoon. I did not watch it. I caught some of the aftermath. The hilarious clip of they talked this morning. Who is they? They doesn't matter. Sweet Jesus. But it doesn't seem like you're getting this instant de-escalating rhetoric out of China. I ratcheted up a little bit here today, which to me, I think that's a reason to keep gold bid a little bit. Do I think ultimately this could step down a little bit as the days go on? I think it's possible, but I'm not going to be super aggressive around fading gold here, at least at this moment, without the confirmation of additional de-escalating rhetoric out of China. My favored way to try to fade gold is through selling upside calls here. And I want to be really careful about the way I do it. I'm super far out. I'm at 3,500. So they got 130 points to come find me. I'm okay with that level of cushion here. I should pause for a second. I'm just blasting by. I'm not acknowledging the chat at all. My sincere apologies. A bunch of thumbs up for Ryan coming in here, giving us that green day. Let's see here. Is that durable goods number just everyone stocking up? Preppers. You know what? I thought about this. I was kind of curious what people what Americans are doing right now. Because I remember back in 2022, you guys know I'm kind of a prepper, right? So during that period of time, I started thinking about what the ramifications of what I was seeing on the screen and just what I thought the multi-year ramifications would be. And then I started buying gold, silver, iodine tablets, kind of outing myself here. Safes, fireproof bags, guns, and canned goods, like tons of canned goods. And so some part of me is wondering, like, I wonder what Americans are doing right now. Like, are they making Costco runs and stuff like this with a bunch of canned goods and stocking up on toilet paper, which ultimately just makes the problem worse? Is that what's happening right now, or is everybody kind of burned out on this whole thing and they're just like, you know what, if it comes, it comes? I wonder. Tell me what's going on. Is it the preppers? I don't think so. Mortgage information, I think it's more likely it's companies that are trying to navigate a very difficult and uncertain environment. I think it was a bunch of people trying to get ahead of the tariffs and do as much upfront purchasing as they could before their costs went up. That's my guess. A lot of it was transportation. I didn't dive deep into the report like I usually do, but at the headline, it looked like a bunch of that was in transportation spending. See here. Victor's wondering what the exec, Donna Skade, what's up, Donna? Victor's wondering what the exec and the C-suite are thinking. They're trying to figure out how to cover their ass through earnings season, in my humble opinion. Of course, Donna, of course. You know, this in this period of time, don't expect CEOs to be a hero, and don't expect analysts to earn their salaries. You're on your own, everybody. You're on your own to pick a multiple that makes sense and earnings, an S&P earnings number that makes sense, and apply a reasonable multiple to that number. You're on your own. You're on your own to try to navigate what the cost of money is going to be. And the only thing we really have is price, right? The implied curve is going to tell us what the rest of participants think about volatility and uncertainty. It's going to tell us what the rest of the participants think about the cost of money going into the future. But don't expect some analyst at JP Morgan to write up some pretty report and tell you exactly how to navigate this. It's just not going to happen. They're terrified of losing their job. If they put something specific on a piece of paper that ends up being wrong, that's their ass, not yours. It's an incentive game, baby. I'm waiting for Besant Elon cage match. I don't think that'll happen. I just don't think. I think there's, if I could go this direction for just a little bit, I've been thinking about this a lot. Because I made this joke the other day that somewhere, you know, as markets were getting more and more positive, I made this joke that just remember somewhere, Peter Navarro is practicing in a bathroom mirror somewhere with a hairbrush. He's practicing his next national TV interview. And the joke of that is probably not a good joke if you have to explain it, but the joke is he's kind of the tape bomber. Anytime he talks, he's ratcheting up rhetoric, he's ratcheting up tension, and that's probably not what the market wants right now. The market wants these two parties and most global parties to work towards arrangements that are predictable, that allow business predictability and investment. That's what the market wants right now. So that's sort of the underlying joke, the underlying frame. But behind that, there's something I think a little bit deeper between the administration itself. Like Navarro's position on a lot of trade issues seems to be one thing, whereas the Treasury Secretary's position on a lot of these issues seems to be a little bit different. You know, if I had to pinpoint what I think where Besant's position is, I think he views these trade negotiations, in particular tariffs, through the lens of negotiating leverage. I think you can't say that because as soon as you say we're only putting this on the table as negotiating leverage, you lose that negotiating leverage. But I thought Besant looked at these trade negotiations, in particular tariffs, as primarily negotiating leverage with a side of strategic the need to be strategic around certain supply chains for certain products and for things that are of strategic national importance for America. So there's a side of that, like 80% of critical minerals being refined in China, 80 to 90%. That's probably a national security issue to a certain extent. You know, I can go on and on down the line, like our antibiotics. I think a significant percentage of antibiotics, the raw ingredients, the raw inputs to those are coming from China. So there's an argument to be made around strategic national importance and protecting those supply chains. But in general, I thought Bessent's was likely on the negotiating leverage side of things. And then Navarro, I think, was on the other end of the spectrum, which is we're going to replace the IRS with the External Revenue Service. To me, again, I had the perspective of this is negotiating leverage, that they want to work themselves to a place where these tariffs are minimal and really just protecting strategic American assets, is what I thought and wanted to believe, and that's the way I'm looking at this card game. And on the other end, there is this person who I saw as useful to telling the story at the card game. Because if it is negotiating leverage, then the guy, you need somebody that kind of like, they're like, are they serious? I think this guy's serious. This guy made up his own reference. He made up his own fictional character and referenced it. I think he might be crazy enough to try to do this. But the longer this goes, the more it seems that those are perhaps not like Trump's kind of in the middle and not quite sure which faction to listen to. It seems over the last couple of days, Ron Vera or Peter Navarro's gotten sort of sidelined. He's nowhere to be found, which is probably a good thing for risk assets. But I suppose what I'm trying to do is get back to this point of like what I thought this was initially and where it seems What I thought this was, I think, is more closely aligned to what I imagine Bessent's point of view on this is, and what Navarro's point on this is like being serious around replacing all tax revenue with tariff revenue. That's, seems wild. And why do I say this? To get to your point, Grumpy Mike, is that I think Bessent and Elon are probably a lot closer. I don't think they're going to have the same spat that Elon did with Navarro, because I think Elon sees the position of Navarro as sort of like it's a non-starter. It's clearly not. It's not going to work. Andrew Warren says they're pressing the shorts. Who is they? Doesn't matter. Yeah, I think that's the question here. Obviously, as 5,500 an interesting level to fade. I'm not net short yet, for whatever that's worth. I think that there's probably a decent amount of volatility contraction that can still occur here. And I think if you were going to get short, it could happen, right? It definitely could happen. You can get escalating headlines tomorrow, and this thing could very easily be revisiting 5,200. So I'm not short, but I'm pretty close to flat. I'm getting pretty close to flat. So as NASDAQ and a lot of this stuff that I own has rallied, the rally in some of this stuff is insane. As the stuff rallies, I'm lightening up deltas in the portfolio. When I say insane, I'm talking, we've had Hasbro moved 15%, right? SMCI moved 9%, CrowdStrike 7%, NXP 7%, Freeport-McMoran 7%, Palantir in one day moved 7%, but we've gone from 70, we're back up above, we're nearing 110 after just a few weeks. So while the majors might not be at highs or retesting highs, a lot of these underlying stocks have had incredible moves. In the last 5 days, you're talking anywhere from 15 to 25% in some of these underlying instruments. And I think we talked not long ago. It's like, where would you rather take risk? Would you rather take it in the majors, or would you rather take it in individual securities, in individual stocks? And my point of view at the time was, I think when things were getting brutalized, you take it in individual stocks. Why? Well, it's because at the market level, at the S&P 500 level, you're already getting a bit of concentration risk. So the whole point of buying a diversified index or the marketplace is so that you can diversify your downside risk a bit. But if 30 cents of every dollar is basically in 5 to 7 stocks, you're not really getting the diversification. So if you're not getting the diversification to protect your downside risk, if these 7 stocks get murdered, then why not just take a little bit more individual company risk, which gives you the beta exposure on both sides? And it seems crazy in the moment, but the individual stock risk is the one that paid off, at least over the last 5 days, for sure. Let's see here. Victor, I ask you a question, and how did you invest in those items? Which items? Michael Anthony, which items? Oh, Victor, which company did you invest into those items you bought? I don't think, okay, here. I don't understand your question, Michael Anthony. Help me out, my friend. Victor, you confuse and that you were long, but you're saying you're short now. Am I saying I'm short now? I'm not short now. I'm not saying I'm short now, my friend. I'm net long a few hundred portfolio deltas, which is almost nothing. So I'm getting closer and closer to flat. I am not short, but at a portfolio delta level. So I have a portfolio. All of those beta weighted portfolios equals a number. Okay, let's say it's 1,000. And if I want less delta exposure, I could sell a future against that portfolio long delta exposure. And that future will decrease the delta of the portfolio. And I can do that. I can decrease it a couple hundred deltas. So instead of 1,000 portfolio deltas, I have 800 or maybe 500 or 200. Or I could sell enough that I flip the portfolio delta short. So I understand how that could be confusing, but if you think about the portfolio as beta weighted portfolio deltas, I have a beta weighted portfolio delta in my long portfolio, and if I want less exposure, I'll sell futures to get less exposure. That doesn't mean I'm short. It means I have less delta. So as the market's rallying here towards what I find is fair value, 5,500, I'm now selling futures against the portfolio to lower my delta and protect those profits, with the idea that I think if we are able to break through 5,500, I think it might be hard for the market to power through 5,800, and I would like to protect my profits the closer we get. So that's kind of how I'm doing things. Hopefully that's not too confusing, Michael Anthony. But net long is where I am now. I don't know, is that confusing? Tell me. All right, let's keep cruising here. Let's take a quick look at the yield curve. The long end, as I've been mentioning, over the last couple of days, we're getting this flattener. So the long end yields are falling a bit. The short end yields today did not fall. So they actually did fall yesterday, or excuse me, short end yields did not rise today. They did rise yesterday. Today, you still get a flattener. The short end rates did not rise as fast as the long end rates. So you still got some flattening in the curve. The short end, the 2 years are 3.8. The 10-year at 4.33. And the interesting thing here, I think the other day, the 210 curve was at 65 basis points. This is, I believe, 2 days ago. The first day we saw the softening of the rhetoric. And I made the sort of the bet, not the bet, the call. I don't have money on this one. I kind of want to be on the steepener side, not the flattener side. But I made the call that if the market does believe what they're hearing out of the U.S. administration, and if China doesn't blow it up with opposing rhetoric, then you could get a situation where you get a flattener here. And my guess was that we get a flattening into 45 basis points. We're at 65. So in just 2 days, you've got a 10 basis point flattening of the 210 yield curve. And we are still only at 115 in the long end. I know I'm talking bonds here instead of the 10-year, but you're still only at 115. So there's room for the long end to rally in I'm talking price here. There's room for bonds to rally, just to get back to that 117 level. And again, yields move inverse to price. So if bonds are rallying, yields are falling. And so I actually do think that might not be that far off, that we could get ourselves back to around 45 basis points in the yield curve. And that might be sort of an interesting part to start betting the steepening again. Unless I'm totally wrong and they're going to flatten this thing into an inversion. But, I think there's some levels here. 3,100 gold becomes a little bit more interesting. I think 45 basis points or less, the yield curve, betting the steepener starts to become a little bit more interesting. I think 5,600 starts to become interesting area to start fading the strength in equities. But we're just not there yet. And so I'm just trying to be patient, trying to capture some of the just incredible upside momentum that we've had. Didn't you say you invest into can items and other items? How did you invest in them? Oh, I'm not saying, I get what you're saying. I'm not saying I bought, I'm saying I didn't, I'm not saying I bought like gun stocks. I'm saying I bought guns, like physical firearms. And I'm not saying I bought canned goods stocks, like Campbell Soup stock. I'm telling you, I bought actual canned goods back in 2022, 2021. As that's sort of what I'm implying by I'm a prepper. Like I wanted, 30 to 45 days worth of dry food stuff, so maybe even longer. Oh, Mark, you just said that. You said that those ugly words, my friend. How many months has it been since bonds inverted? Recession is imminent. Let's take a look. How many months has it been? What's the countdown? Is it 12 to 18 months, something like this? September 2024 is when the uninversion happened. Cole Kyle says Vic is a real prepper. Less so here. It's a little bit harder to be a prepper in Singapore. You can't own a firearm. There are more fresh fruit here. There's like less of those just going in and buying a bunch of like Campbell's foods or something like that. Plus, the sodium in that stuff will kill you. Brad Glazer, I'm basically delta neutral and slowly selling upside calls into this move. I want to be careful because I do think this thing could get people chasing a little bit to the upside, I don't think that there's a lot of conviction in the market. And whenever there isn't a lot of conviction, you got to rate. It's like the dollar on the string. You put $1 on the string and put it out there in the street. People don't grab at it. You got to put $100 on the string. And then you get a couple more people grabbing at it. And I sort of think that way about the market sometimes. When you don't have enough conviction, you got to get people chasing a bit. I agree with you. I don't have the the conviction we just go straight to all-time highs from here. I still think this thing has a long way to go. The market is pricing this like the U.S. administration's just, they're going straight for an off-ramp and they're trying to find it. I don't know that that's what happens. There's a part of me that would like to, I think, see that. There's a part of me that would like to say, okay, the strategic, or excuse me, the negotiating leverage you tried to create worked in some ways. It didn't work in many ways. It probably wasn't necessary in many ways. I think it was probably used, it could have been used for speed. But I honestly believe if you went to a bunch of these countries and you just said, look, what can we do to incentivize you to use excess dollar savings and invest that back into U.S. CapEx instead of buying U.S. financial assets? What can we do? I think they probably would have had more or less a favorable response, but it was the extra part that I think they wanted, which was for a lot of other countries to come in and say, okay, we are going to be a part of your alliance and negotiate against China. But if that was the goal, I don't think starting it off in a hostile way, it was just going to be really hard to get a country on your side when they need both sides, right? They need demand from the United States and they need supply from China, and they do not want to pick sides. And your ultimate goal is to force people into picking sides. And I think there's a realization that there's an unwillingness to do that, and that the only way that you're going to make new trade deals is by eliminating that as sort of a forcing function on other nations. Because I don't think they're going for it. And so if that ultimately is not the goal anymore, then the aggressive, hostile act up front it's easy to see that, well, if you weren't going to get what you ultimately wanted, then the attempt of going this pathway wasn't necessary to be this aggressive. What's that old saying? You catch more flies. Is it you catch more flies with honey or something like this? All right, let's keep cruising here. All right. The other thing I'm going to keep talking about this, which is Bitcoin at 93.5. I think I keep getting more and more excited about this thing, and I don't know if that's good or bad, because I don't want to feel any emotions when I'm talking about these assets. But the amount of institutional participation in some of these assets right now, it's pretty. I mean, there's a lot of money being thrown into this world. I talked about this a little bit with Tom earlier, but there is a gentleman who I'm a big fan of. There's a guy named Jack Mallers. I'm just a big fan of him as a public speaker. To be, I think, 21, 22 years old, he's super young. I don't know how old he is. I think he's in his early 20s. His ability to articulate his point of view on the world is, it's on par with people that have been doing this thing, doing public speaking for decades. But he just had this partnership with Tether, SoftBank, through Cantor Fitzgerald. This thing called 21. It's expected to launch with, I'm reading the press release here, but 42,000 Bitcoin and a mission to maximize Bitcoin ownership per share. So he's pumping like two different metrics. The one I find most interesting is BPS, or Bitcoin per share. So it basically starts off as a gigantic pool of capital. Here's the way I'm sort of conceptualizing it. if you can imagine a SPAC, I don't want that negative connotation of the SPAC to be utilized here, but if you could imagine just a pool of capital, but the goal of that capital in a SPAC was to go acquire a company, and bring them public, right? That was the goal of the SPAC. So to create sort of accretive value of the cash. In this case, the way that I sort of see this instrument and what they're trying to set up is something like MicroStrategy, that it is effectively just exposure to Bitcoin, and is trying to grow the exposure to Bitcoin. And so what this instrument looks like it's going to be is sort of a pool of capital, and the goal is to find ways to maximize the exposure to Bitcoin, so to increase the quote-unquote Bitcoin per share. And I don't know if this thing is going to work, and I'm not pumping it in any way, shape, or form. I am fascinated by, I think, the idea behind it, and I think the people behind it. Having been a part of something similar in the past where you get big, moneyed, storied, experienced interests together and say, hey, let's put all of our knowledge and expertise together and put it behind this entity. I've been a part of something like that, and this is similar. I wonder if Jack's going to have what it takes to navigate that group, Tether, SoftBank, Cantor, all these people are going to have really strong ideas about how to do this. And young 20-year-old navigating all that capital and all those strong opinions, it'll be difficult, but I bet it's going to be a really interesting outcome here, and I'm going to be watching it. Anyone else? Theta Trader says, this is why I like IBIT. Gives you the ability to scale in and hedge with options, considering buying a few hundred lots, selling near at-the-money calls against one of them. I like IBIT, right? But like that's static exposure to Bitcoin. And what's interesting about this new concept is increasing the exposure to Bitcoin. All right, let's see what they... Personally, I'm waiting for the appearance of the Lorax. You catch more flies with honey than vinegar. Thank you, Jeremy. All this talk about red dye number 6, corn syrup, nail polish, and sodium is making me hungry. Nicole Kyle, I don't trust anyone who wasn't around for the 2008 collapse. Amen. It's not that it's not that I don't trust. I just think, the people who are around for that, they have dead eyes. And that's who I want to talk to. I want to talk to the people with dead eyes, with no feelings behind their eyes. Sleepy Moke, I hate everyone. Everyone's long but me. I'm joining a cult. That's funny. Victoria, magic internet money. Oh, that interview with Gary Stevenson, when he talks about Bitcoin being magic internet money, God, one of the greatest lines. One of the greatest lines. The guy goes, asks him something about Bitcoin. He just looks at him, and then with this, Gary's, regardless of what you feel about him, he has this amazing ability to just cut through the bullshit and just speak to the essence of a thing, And the guy goes, oh, really? Like, you're not supportive of Bitcoin? And he looks at him and he goes, it's not real, man. I watched that part of that interview 100 times. Just for like how sort of refreshing and how much of a dart that one little point was. It's not real. What are you talking about? Anyways, the other things here, a little bit of performance. Freeport McMoran up 7%, baby boy. Newmont Mining has done really well as well, up another 5%. So a lot of these things, a lot of these miners, a lot of these things that deal in raw materials, surprise, surprise, everybody. That's kind of what the game is about. Now it's finding all of the materials and playing this game of like Monopoly. The Western Hemisphere trying to find all their raw materials, Eastern Hemisphere trying to hoard all their raw materials. And you know, the one thing I haven't been talking about that I want to talk about a little bit more in the future is water. I know I'm way late. Like in The Big Short, your man Michael Brewery was talking about how to invest in water way back when. But now that, you know, if we are going to move forward with building any new manufacturing plants, whether or not they have water or not, if we're going to be building these gigantic data centers, you know, this was probably, along with that NVIDIA boom, this was also, how the hell do we cool these data centers? You know, I guess this is, by the way, I should say what this is, AWK. It's American Water. It's in New Jersey. Basically, water to a lot of the East Coast. WTRG is like Pennsylvania. AWR is California. You know, there's a handful of these. But I some part of me keeps thinking, or I've been looking at, because I'm late on this, what is the most cost-effective instrument in the space and water, and most interesting instrument in water to start building a position on. I'm so late on it. I'm almost embarrassed to bring it up, but I don't have exposure here. And given the fact that AI, I don't want to call it bubble, but like the AI hype has lessened a bit. I'm sort of curious if there's any interesting discounts in this space. I've been looking at it. I'm giving you the symbols now. I haven't done the deep work yet to figure out if or what I would like to do in this space, but just throwing it out there. And you know what got me thinking about it? I'll tell you. This will tell you what algorithms I'm in online. But what got me thinking about it is your boy Klaus Schwab in the WEF sort of stepping down and getting replaced. And then the guy who replaced him has been quoted in the past as saying, water is not a human right. And I thought, well, if the guy who's running the new guy who's running the WEF doesn't believe water is a human right, I should probably have some exposure to water. So, Chaos says, water's turning into the new liquid gold. America's surrounded by water. Many countries have water desalination plants. They do, Peter, but yeah, I've got a lot of thoughts. Maybe I'll get them together before I come here and start chirping on this. I could make the case, my friend, air is free, but we found a way. We're finding ways to pay for carbon emissions. You with me? Like something being abundant somehow is not stopping us from finding ways to make it even more scarce and therefore profitable. You with me? Like it doesn't cost you anything to exhale, but it seems like there could be a world at some point. There's a pathway to a world where we are all hyper aware of our carbon footprint, and that in order to have a certain carbon footprint that is above some maximal allowable level, that would cost you money. You'd have to pay for it. So I'm not saying it will happen. I'm being facetious when I bring up the WEF guy, but Lucid says, touche, Vic. Just because something's in abundance, don't put it past the capitalist ability to make it scarce. All of the Mag 7 higher today. So NVIDIA up 3.6%, Tesla up 3.5%, Microsoft up 3.5%, Amazon up 3.25%, Google 2.5%, Meta 2.5%, and Apple, which was struggling early in the open for maybe an hour or so. When I say struggling, it was the only of the Mag 7 which were unchanged. I know I could add a few instruments to this, but I'll just keep it clean. Ended up rallying about 2%. What the hell is a carbon footprint? If you don't know, you're going to know one day. It's something you don't have to worry about. Put it this way. It's something you don't have to worry about if you're taking private planes to talk about the carbon footprint, apparently. So it's a carbon footprint is a thing you take a private plane to elite conferences to talk to other people who took private planes about how other people should limit their carbon output. That's what a carbon footprint is. Zing. Okay, let's talk a little earnings here. Da-da-da-da-da. Sorry, give me just a second. I think we had a handful. Intel, I think after the close, Google, handful of others. So Intel, 2037 down $1 here and extended. I think that's inside. Yeah, inside the expected move, at least for now. So if you sold Vol, you're good money, knock on wood so far, and Google up a little bit here. 159 is where they closed. 167 is where they're currently trading. So another win for the good guys. Inside the expected move currently. I think I saw, the only thing that I'd read coming into this is that they had kept, I think, their CapEx guidance. Still going to spend big money. What was it, $75 billion, something like this? Some insane number. Can't find it offhand. But I just think all of these stocks, I had only traded Microsoft off this low. And I talked about it earlier in the week that I thought as we started to retest some of these lows in a handful of these stocks, not all of them looked the same, right? Netflix doesn't exactly look the same as Microsoft. But I thought as we approach Microsoft, I said the 363.70 call spread, which was even money at the time. I wanted a super minimal capital exposure here just in case, for whatever reason, the levies broke to the downside. And so I wanted like even money, but I wanted something where I could sell something against a long so I wouldn't be paying volatility through the nose. And, a decent rally here in Microsoft, most of the Mag 7s. So anything really you picked a few days ago, you would have been a winner. So trading it against the low didn't really, sound smart or whatever, but it ended up working on anything you threw a dart at a few days ago for the most part. You're probably up somewhere like 15% on something you bought 3 days ago, which is the greatest irony of this game. I say this often. It does not mean we're out of the woods. I do not think it's just up, and away from here. I think we're going to have to deal with some hard data that's coming. I think up until now, I know there's this big bickering back and forth, soft data, hard data, soft data, hard data. Soft data is basically survey, it's sentiment. How do you feel? What do you think? Hard data is what happened, right? What did people spend? or did they not spend? Those types of things. So there's a big difference right now between the surveys of how people think things are going to work out for the hard data in the coming months versus the hard data, the actual hard data. You know, what mortgages, housing starts were up, like housing purchases, home sales were up 7% when the expectation was maybe a growth of 1 or 2%. Durable goods up 9%. All the hard data, you know, people's earnings, people are blowing out earnings expectations. They're blowing them out, and they're kitchen sinking their guidance. So there's a feeling out there right now, and there's what I think is going to happen. All of that stuff is horrible, but what is happening, or what has happened, is a lot of pull through and demand. And the biggest question is, when you get to the other side of this, when you get a couple of weeks or a month or 45 days in, do you start to see a turn and a pivot in the actual hard data? That may come. But for now, this game, it's really hard when everybody's freaking out, and when everybody's really freaking out about what's going on when you look outside your window. It's the hardest thing to do is push the button. The hardest thing to do is push the button in a risk, in a way that's managing your risk, in a way that's not just jumping out of the window and saying, okay, hopefully everything works out. And then when the calm returns, when the environment returns where people are like, okay, I feel comfortable taking risk. Well, guess what? You know, you're not at 48.35, 49. You're at 5,500. You missed 600 S&P points before you got to the point where people are like, oh, finally, there's easing rhetoric on both sides of this trade negotiation. And if you're always going to wait for the all clear signal, that's a lot of discount that you could end up missing, man. And that's just that's the funny, sick part of this game. And let's see what we got here. 100% yes, Vic. Broadcom and Nvidia can make chips, but if they're not allowed to sell them, then question mark, question mark, question mark. Yeah, right. That's the new question. I won't call it the question, but you know, Nvidia comes up with their own chip, the H20, to sell over to China that gets around all these export control specifications, and then it seems Huawei comes out with their own chip, highly capable chip, and then the question turns from okay, NVIDIA's really smart, not the question, but the narrative turns from NVIDIA's really smart. They're able to sell the best chips to the West and Western allies, and they're able to sell this sort of 2 or 3 version behind chip to China, and they get to profit in both parts of the world. And now it's like, oh, actually, have we just frozen ourselves out of revenue? AI revenue from China, hardware. I don't know. Get those AI models working on fusion to power themselves. Yeah, pretty good day for uranium and nuclear today as well. CCJ, which has had this nasty little slide from 62, almost cut in half, down like 45%, something like this. Up another 4.5% today. So this is one. If you don't know, I have a pretty decent position in this. I collared it up for most of that downside move, but for some of this, I would say from like 46 to 35. It was just open exposure. So yeah, I'm long CCJ. I'll stay long CCJ for the foreseeable future. I did read something the other day, though. Doesn't it cost us like 5 times the cost for nuclear power versus China and South Korea, a handful of other countries? Maybe 4 or 5 times as much. We got to figure out some way to bring our costs down, bro. Jay Stat says, bad news from the future. Fusion will still not be ready, but something called Brondo is very popular. All right. We'll do a few more things here on sectors and then the rest of the earnings coming up. Almost everything in the green here. I think yesterday, I can't remember who said it, but they said shorting Staples is the most contrarian trade on the board. On a day-over-day basis, congratulations. That was literally one of the only things you could short today. But technology was up near 4%. Industrials up 2%. Telling you, man, we're going to have to move some dirt in this country. Materials up 2%. And then the only thing on the downside here was Staples down 90 basis points or so. And then the rest of the earnings calendar for next week. Big week next week, everybody. NXPI, Booking, Starbucks. Come on, where's the big ones? First Solar. Some of the solar names went absolutely bonkers this week. Not a bad setup. PayPal, Microsoft, Meta. Yeah, huge. Like next week is sort of the Super Bowl earnings week. You get all the pedigree stocks reporting. And again, I wonder what happens. Some of the market, I want to believe that part of the market is forecasting this today, or has been over the next couple of days. That as long as you're not worrying about escalating rhetoric, and you're even positioned, the U.S. administration positioned to lower tariffs, as long as you're moving that direction with rhetoric, whether it happens or not, you're putting that, you can put some of that risk off to the side, and you can just go, okay, what happens when when Microsoft and when Apple report next week, and a lot of these big names? Well, if the current earnings season is a pattern, you get blowout numbers again. Now you have to couple that with a plate of guidance that's going to be either pulled or they pull guidance altogether, or they lower guidance. And they talk about the dollar hit, the tariff hit in dollar terms, most of these companies. But I think that it's probably going to be decent for at least narrative risk next week. But the point is, how much of that has already been pulled forward into the last 2-3 days of risk taking? Moving at 2.5% clips. We're already at 5,500. You can get a little bit more in there, but the question is this a buy the rumor, sell the news type event? If we get any more of this optimism priced into the marketplace, we're at 5,600 going into Apple earnings, and they blow it out. We're at 20,000, 21,000 in the NASDAQ, and they blow out earnings. How much more upside is there going to be? To me, that's sort of an interesting setup going into next week. How much optimism can you price into equities, in particular Mag 7, from now until the middle of next week, Wednesday after the close? And I think that will depend. That will decide, I think, for me, how I play the back end of next week. What do you guys think? How do you play this from here? You super optimistic? Are you 5,600? Are you 5,800? Are you 6,000? Are you new highs by the end of summer? What do you guys think? Victor, what other companies do you like to invest in the market? Okay. My biggest positions right now are Newmont Mining, Freeport-McMoRan, CCJ, probably Tesla is up there. Yeah, a lot of materials companies. I'm starting to buy up a little bit of energy companies. I think at some level, and oil can get too low. I know that might sound weird, but at some level, you start to have a problem with rigs closing down, and a price for oil that can't be sustained by people's. You don't have the profit margin to be sustained. It's you actually get production that starts to close down, and I think in that case, the administration is probably going to look to fill up the reserve. So I think, at 60, am I buying oil? Not necessarily, but I think we're getting to a place where could we see stabilization? Yeah, maybe. And if so, I kind of want to start. I have been looking at energy stocks, and I'll continue to do that. So I'm basically I want the world of materials, things that you can't print, and things that they don't rely on necessarily a robust consumer. I know that sounds crazy, but if you can have a massive capital expenditures by these big companies that are growing these plants, building manufacturing, diversifying maybe their consumer. I want to own stuff you can't print. That's it's energy companies, it's materials. And so that's the area that I'm playing in. And then on the flip side, I want to own the right side of the distribution. So right side of the distribution is the highest beta I can find as an offset. And that's Bitcoin. So I buy materials on one end, and I'm buying Bitcoin on the other. Sort of this barbell approach. I used to buy technology on one end, but cheap tech. So things that would automate certain industries, like Intuitive Surgical was a big position of mine for 2 years, which I've gotten out of a lot of it. But that type of tech, not like Netflix technology, real tech. And that's how I would barbell my approach. But now I'm sort of replacing a lot of that stuff, which has got really expensive on the tech side, which is Bitcoin. If we can make another high, then where is the money coming from? Really good question. That's a great question, actually. The money either, I've always hated this, off the sideline. I really hate that. But what that would mean is yields go lower for some. How does that happen? Let me leave that one alone. I think it could come out of gold. I think if Bitcoin sort of stays, it doesn't move much. You could get this. We've been in this 80 to 90 range. You could get this interesting dynamic where an incremental dollar doesn't go to Bitcoin because you're looking for vol. You're looking for volatility. So if we've gotten cheap enough here, and I think you've kind of seen that. An incremental dollar towards Bitcoin made less sense than putting an incremental dollar towards, let's say, Nvidia at 80, or Microsoft at 350 or whatever the number was, or Palantir at 70. There was just more upside vol in those bets than a bet at Bitcoin at 85. So if both become more fairly priced, I don't think that comes from there either. I just think it comes back from international money flow. So if there are deals that are made, people become more confident in the U.S. markets. Yeah, perhaps some of that optimism in Europe and European markets right now cools. Perhaps some of the optimism in Latin America cools, and some of the optimism in China cools. Some of that capital flow comes back. But that's a really effing good question. Down 15% from here. If you're interested in materials mining, have you looked into Australian companies such as BHP and Rio Tinto? Rio Tinto, yes. BHP, not in a while. I'll take a look, Peter. I appreciate that. Tilray was up to 11%. So was MSOS. So the marijuana trade just... I don't know if that's short covering or what. Was there a headline about marijuana today? I mean, I just don't get it. At some point, we got, if we're not gonna implement a wealth tax, and we're having difficulties cutting spending, just what are we doing? Legalize marijuana and tax it. Like don't fully legalize it. And put a decent tax structure around it. Don't tax it out of existence. And, it's not going to solve all of our revenue problems. But, I mean, if we're digging through couch cushions to find grants for a couple of $100,000 that we need to cancel, come on, bro. Legalize it. What are we doing? But anyways, yeah, MMSOS was up 20% in one day. Where did I want? I did want to talk a little bit about Doge, if you don't mind. I think I'm going to take us out on this. So, when this whole thing started, the Madison Square Garden conference, or whatever that thing was, the Madison Square Garden convention, or whatever it was, and Howard Lutnick gets up on stage and he introduces Elon Musk. And every other visitor or guest on that show had been introduced by the VOG, the voice of God, basically the person behind the scenes you never see. They're just there for the voice. But in this particular instance, when Elon came on, Howard Lutnick stayed on stage and he introduced Elon and then stayed there and asked him, how much do you think we can cut? And Elon said $2 trillion. And if you know anything about the federal budget, and what Doge was supposed to be, which is they were not allowed to, you're not cutting defense spending. That's not in your purview. You're not allowed to cut entitlements. Not allowed. That doesn't go to you. You're not allowed to cut like these mandatory items in any way, shape, or form. So if you know what the overall budget looks like, and you hear a guy say $2 trillion, you're like, this guy's smoking crack. It's not happening. They're not going to find $2 trillion to cut. And in that moment, I was like, I thought it was Lutnick. I looked at Lutnick and I go, you guys had to have planned this before. Anybody that does public speaking, you never ask a question that you don't already know the answer to. Unless you trust that person so much and you both have a great rhetoric. But in that situation with the stakes so high, you don't ask a question you don't know the answer to. And so I thought if he knew Elon was going to say $2 trillion and he asked him that question, he either has bad ethics because he allowed that information to get out to the public, or he's not that intelligent to think when Elon told him $2 trillion that he thought that was feasible. One of the two. Now, Lutnick told this story later in a podcast, and what he said was Elon was supposed to say $1 trillion, and then he was supposed to say, as Commerce Secretary, I'm going to add $1 trillion in growth. And then together, that's how they're going to balance the budget. $1 trillion in new revenue, $1 trillion in cuts, and that's how you close a $2 trillion budget deficit. That's what he said. So maybe my initial read was a little bit off, a little bit too aggressive on Lutnick. But the point is, this starts out with Doge is going to find $2 trillion in savings, which I thought was ridiculous. And on this show, I even said it was ridiculous. I said immediately after that, I think in an episode I did with Chris Vecchio, I thought the real number was going to be between 300 billion and then at its most optimistic 800 billion. I put 500 billion as my mid mark, and then I said probably plus or minus something. So 300 billion to 800 was my guess. Later on, Elon walks back his 2 trillion to 1 trillion, and that ends up what looks like the goal for a while. And if I'm not mistaken, they are ending somewhere, they're ending somewhere around 150 billion, something like this, if I'm not mistaken. Which is, even for me, who had, I think, realistic expectations up front. I knew the 2 trillion number was bullshit. I knew 1 trillion was optimistic, and normally what people in those positions do is whatever their real number is, they double it. So when Elon said the real number is 1 trillion, I thought I was about right by thinking 500 billion was the mid mark, with 300 to 800 billion as the real range. And at this point, for Elon to step down and start doing less work at Doge and start doing more work at Tesla. And I want to be honest, I think I've been a supporter of Elon in many ways. I think there's not enough being talked about by the people who did support Elon or did support the efforts of Doge. It did support the efforts of trying to cut waste and fraud and abuse from government spending. If you were on TV doing all these interviews on Fox and all these things, making a big deal out of the things you find, let me say this: 160. We're better off as taxpayers not spending $160 billion if we didn't have to. So it's not like, I'm not one of these people that go, oh, what's $1 million? If we weren't supposed to be spending the $1 million or it's going to nonsense, then it's good. But I think the over-promising and under-delivering, it might be okay at Tesla. It might be okay for a private company. It might be okay for an entrepreneur who's used to raising capital. In order to raise capital, you have to get investors excited about your idea and your vision for the future. And there's probably no better entrepreneur living or breathing than Elon Musk. But to overpromise and underdeliver by this amount on something as important as this, and then to bow out and say, I'm going to spend less time on this initiative and I'm going to go back to working at my company, it leaves a bad taste in my mouth. And this is coming from a person that supported this effort. It leaves a bad taste in my mouth. Now, I get it. I get his personal incentive structure is Tesla's falling apart at the seams. When Dan Ives is on TV telling you, when Ross Gerber's on television telling you, you need to drop all this shit and start focusing on this company, and you've lost tons in shareholder value after the Trump bump. Like, I get it. Your personal incentive structure says this is what you need to do. But trying to pretend like this is some big win, and I don't find enough people are having that conversation. It wasn't a win by any stretch. It was, I think, by their own numbers, was a massive sort of failure in what they endeavored to do. And by my own realistic expectations, it missed it by 50%. And so I'm a little disappointed. And I think in the interest of fairness, in the interest of two-sided, hopefully unbiased coverage of ideas, I gotta be honest, man. I get why he's going back and spending less time on this initiative. But he made a lot of headlines about all the waste, fraud, and abuse and how much they were finding. And to get to the end and you're at $160 billion and you promise the world $2 trillion, bro, somebody's got to say something. All right, everybody. That's going to do it for me here. I am going to be tweeting up a storm all weekend. I appreciate everybody that's been engaging with me on Twitter at Victor Jones. The Owen Jones is 0 because I like to be difficult. If you want to follow me there, you're more than welcome. If you want to send me an email, if you'd like a more private audience, you're more than welcome to do it. Victor.jones@tastylive.com. Yeah, at tastylive.com. Feel free to send me an email. I appreciate everybody that watched this week. Appreciate everybody that tuned in. Do me a favor, hit the like button if you appreciated what you saw at any point during this week. It's an easy way to support everybody on this side of the camera, as well as everybody working hard behind the scenes. I will see you back here next week. It is Synthetic Friday. But if you're around for Sunday Futures Open, join us on First Call on Sunday, 5 p.m. Central Time. Otherwise, I'll see you back here on Monday, same time, same place, same great network, only on Tasty Live. Until then, peace.